Welcome, welcome, everyone. Hello, hello. If you're in the chat room already, let me know you're here. I just started the Clubhouse room. I am excited to get things going. What's up, everybody? I already see you've got roughly 20 people or so in the house. Cool, cool, cool. Nice, nice. All right, welcome everyone, welcome everyone. I am live on Clubhouse. I'm live on LinkedIn, Facebook, and the YouTube. All four platforms going at once. So if you are listening on Clubhouse, if you're tuned in on Clubhouse, you can go to my YouTube channel and you can watch me live because I am going to be using the whiteboard for our discussion today. And if you're vice versa, if you're watching on YouTube or Facebook or LinkedIn and you would like to join in the conversation, you want to ask a question, you can do that through Clubhouse. I can bring you up to the stage and we can have a nice discussion, answer some questions. I also have a panel of speakers that I've invited this evening to help me out. They're gonna share what they do, a little bit about themselves, their background, and their take on the becoming your own banker, the infinite banking space, whole life insurance, IUL. We're gonna hear a lot of different perspectives, and at the end of the day, we're gonna be able to make our own decisions when it comes to our personal finances. So I'd like to bring in different ideas, different perspectives, because I find that to be very helpful the more that I engage with my clients. I've now been doing this for roughly 3 years and have had the privilege and honor to collaborate with other very credible individuals, especially some of the people here on Clubhouse. And I've been able to learn so much that I'm like, you know what? Let me start leveraging my platform to get these people to talk to my audience and hear what they have to say. So let me go ahead and yield the mic to Joe, and I'm gonna go in order. I'm gonna go to Joe, James, then Dimitri, in that order, and we'll go from there. So Joe, if you don't mind, can you introduce yourself, a little background, and then your take on becoming your own banker, whether you're familiar with it or maybe not. If you are, general opinion. If you are for it, maybe give one or two reasons why you're for it, and if you're against it, one or two reasons why you don't like it, and we'll go from there, and then I'll move to the next person. We'll just go down the line and then come back and we'll have some cool conversations.
Hey, Denzel, this is Joe. I sure do appreciate you having me on here and allowing me to be part of this conversation here on your platform as well as here in Clubhouse. When I look at my history, I started in the insurance industry in 2001, so about 20 years ago. And I no longer sell insurance. I'm no longer in the insurance business. But one of the things that I did learn in being in that and helping high net worth people is the concept of becoming your own banker and the infinite banking. And there's a number of different titles that were there. And I think the one thing that I would say is that in general, I'm very pro banking and learning how the banking concepts work and learning how to become your own banker, because it's critical for cash flow. I know that you teach on this quite a bit, understanding the cash flow and being able to get the velocity of money working for you and getting your cash moving and working in your favor rather than in other people's, and understanding those concepts. And I would just say that one of the takeaways I have and things I could give you right off the bat is to recognize that whether it's infinite banking, whether it is becoming your own banker, whether it is any number of other programs that are out there, we need to recognize as individuals, that those are typically sales systems, and so they're designed, different ones of them are designed to sell different kinds of products. And so we can talk more in detail about the types of products that are out there and what they are, but it's important to understand the fundamentals and then recognize that that's how you can identify what's going to be best for you. My name is Joe, and I appreciate the opportunity to be here. I'm excited about the conversation tonight.
Awesome. Thank you, Joe. I appreciate that. And now moving on to James. Hello, James. How are you? Another fellow content creator on YouTube. His name of his channel is called Oregon Cashflow Pro, and he talks more recently a lot on the stock market. I've been seeing a lot of live streams, so very, very helpful there. But for the most part, another insurance agent that I've been able to learn from on his channel regarding IULs and whole life, and getting both perspectives. So how you doing, James? Real quick background and your take on becoming your own banker, whether you agree with it or not.
Hey, Denzel and everybody. Thanks for inviting me. Happy to be here. Let me know if you can hear me okay.
Yeah, I can hear you good.
All right, great. So my name is James Barber. My YouTube channel is Oregon Cashflow Pro. It is basically the number one way that I interact and meet with folks, other than one-on-one consultations that I set up. So my specialty is helping people maximize their cash flow. And I'm basically open to any way that we're able to make that happen. So whether it's whole life insurance, IULs, stock market, there are good ways to approach a lot of the different financial instruments out there that can help us achieve our financial goals. And for the most part, I just help people try and figure out what fits their personality, what fits their style. How can we take whatever they're doing and improve it and make it better? How do we maximize their cash flow? That's basically it. I'm a personal practitioner of infinite banking. I have 3 whole life policies personally and 5 IULs. As long as they get designed properly, they can be really great. So I'm not one of the folks that will push one and hate on all the other ones, whether it comes to the stock market or IULs or whole life. Each one has its place, I think, in a portfolio and helping to meet people's needs. I also used to be a real estate broker, and I'm a fan of real estate investing as well. So pretty wide variety when it comes to my history and the approach that we take, and I'm always happy to share my ideas on what can help people out. And I meet one-on-one with folks. They can sign up on my Calendly at calendly.com/cashflowpro if you ever want to chat. There's no cost to that for at least our first sit down, and I help as much as I can. So happy to be here, and let's see what we can do to help folks out tonight.
Awesome. Appreciate that share. And for those that are listening on Clubhouse, there's a new feature where you can message people individually. So if you just heard him mention about the Calendly link and if you're like, wait, I didn't catch that, you can go ahead and send a message right now. And then what I can do on the YouTube side of things, maybe I could just throw that in the comments, or James, if you don't mind, if you could jump on YouTube and just type your link in the comment section on YouTube, so then I can put that on the screen and people can see that.
Yeah, I'll see if I can do that.
Cool. And finally, we go to Dimitri. How are you? Are you with us?
Bill, thank you so much for having me here tonight.
Hello. Go ahead. Go ahead. Introduce yourself and a little background and your take on becoming your own banker.
Oh goodness. So just a quick background. I actually come from the background of banking. 25 years in as a securitization officer. And basically what that means is someone that will secure commercial properties for the banking institutions. We would actually finance and bid for skyscrapers and REIT properties and things of that nature. And so for about 25 years, I did that coming into the banking industry. And one of the things that sort of geared to be towards the insurance industry and the longevity of generational wealth is learning the back end part of how banking works. That actually helped tremendously in figuring out what would be a better avenue for a lot of my existing clients, as well as determining whether I wanted to move out on my own years later, in which I did do so as an insurance agent and also an auditor. And we work with quite a few high-profile clients and talk to them more so about their portfolios and changing the risk in their portfolios using the infinite banking and IUL whole life structures. So that's where my experience came from and how I got started in this particular industry. What I love about the infinite banking structure is the flexibility. I love the opportunity for the generational wealth that you can build with it. Just a lot of the cash flow options and the protections that it can offer if structured properly in your portfolio is very attractive to myself and many other clients that we work with, especially business owners, small business owners, franchisees that are looking for tax credits and tax breaks that will work more in their favor. So this is a particular avenue that has proven to work so much better than just some of the other things that's been out on the market in protections and inflation and recession. So we'll get into that a little bit later, but that's what made this particular side of infinite banking and learning the banking structure. I do have business degrees and finance degrees and things of that nature, but it's nothing like being inside the field and being in the groundwork or working with your clients and analyzing their portfolio to meet a goal that makes more sense. So that's where I come from, and I appreciate you guys bringing me onto the floor and being a part of this awesome panel, and looking forward to the conversation.
Awesome. Thank you for that. Thank you, everyone, for sharing. Really appreciate it. And for those that are on YouTube, if you do have a question, you go ahead and type it in the chat, and I will definitely revisit those questions once I've gone through most of the conversation and dialogue with the people that I have here on the panel. So feel free to drop your question early on in the comment section, or like I said, if you want to jump on Clubhouse, or if you're already in Clubhouse, you can go ahead and raise your hand, and I will eventually bring you up on stage once I've gone through really just talking to the speakers for the most part. So what I'd like to do is I've already got my camera on the board here, and I'm going to give my take on becoming your own banker. You know, is it a scam? Is it possible to become your own banker? Or is this a scam, a sales scheme strategy? You know, let's really look at the good, bad, and the ugly. I like the way Joe really brought up the whole, the difference between really the product and then the sales terminology or marketing terms that are used in the marketplace. And this is something that I do cover on my channel quite often because I think people get very confused really quickly if they hear the words infinite banking or become your own banker or cash flow banking, dynamic banking, privatized banking, family banking. There's a lot of different terms to it. And to really simplify it for everyone that's, you know, brand new to it, or maybe you've been studying it for a little while, these are marketing terms that attract the viewer, the listener, right? It brings you in to listen to something that you've never heard of before. The actual product really boils down to two products, as far as I'm concerned. It's whole life or an index universal life insurance policy. Those are the two main insurance products that insurance agents will use in their sales presentation, their sales pitch, and their marketing terms. They're either using whole life or an IUL or both, right? Like my friend James just said earlier, he's got 3 whole life policies and 5 IUL policies. I personally, I'm 25 years old. I have 2 whole life policies, and I'm in the process, I'm gathering data on IUL, and I will eventually obtain myself an index universal life insurance policy to actually, go through it myself and experience the product, see how it works, so that I can, have my own formulated opinion based on, facts, not just assumptions or what I see on the internet. So when it comes to money, just like what James said earlier, he's very focused on cash flow, so am I, and he's very open-minded to all sorts of different ways to create cash flow. And I have the same mentality. I'm very open to all different sorts of cash flowing assets, cash flowing opportunities, income opportunities, active, both passive. If you look on the board on YouTube or LinkedIn or Facebook, you can see how I have all the different forms of currency on the table. I've got fiat currency, US dollars. I've got gold on the table. I've got silver. I've got crypto on the table, right? And I've got credit. These are all the different forms of money that we use to transact business, to do business with one another, to obtain products and resources, information, data, and whatnot. So the concept of becoming your own banker, the reason why I said, is it possible to actually become your own banker? I do believe that every single individual in the United States, I don't know about other countries, in regards to the life insurance products and the whole banking system, but just focusing on the US, because that's all I know so far and haven't really branched out that far yet. But in regards to, is it possible to become your own banker? I'm going to go with, I've come to a conclusion of yes. After practicing this for 3 years, now it's a matter of understanding what does that mean to really become your own banker, to copy, to use the same strategies that Bank of America, Wells Fargo, Chase, JP Morgan, the same systems that they're doing on a big world global scale. Can I do it in my own household? Can I do it with my own living expenses, my medical insurance, my housing, my investing, my savings? Because becoming your own banker is not a product, it's a concept, and it's a process, it's a system. It's a systematic approach to how you and I conduct business, right? And on the board, I also have a book that I highly recommend everyone at least read once or maybe 2, 3, 4, 5 times over. And there's many other valuable books that I've come across, but I would say this is like a foundation, which is Becoming Your Own Banker by Nelson Nash, Unlocking the Infant Banking Concept. A lot of great scenarios, a lot of great illustrations, very, very impactful book. The gentleman Nelson Nash, I would say, gets credit for the term Become Your Own Banker, where his background was in I forget the terminology for it, but he planted trees, basically. So he had to think roughly, I think, 20 to 50 plus years into the future. So this is a guy that is planting trees for a result that he would likely not even see because he'll be dead, So how can we, individuals, United States citizens, how do we as citizens think 50 years to 100 plus years out into the future and obtain results in the now? Is that possible? I believe it is. I want to hear some discussion. I want to hear some dialogue from people that are, in the audience. If you have a question, like I said, raise your hand. I want to, welcome you guys at any point in time. If you got any pushback, definitely, let me know. So a couple things that I would like to bring to the table is the scam part, right? Is this thing a scam? Now, I want to go through the actual terminology that the life insurance industry uses to regulate insurance agents from abusing life insurance products. Okay, I think this would be very helpful for prospects, potential clients, people that are looking this up. There are legitimate, schemes, scams that insurance agents have used in the past, which is why on the state exam and on continuing education as an insurance agent, we're given a refresher. Like literally right now, I am going through my continuing education hours to renew my insurance license. And I got a little refresher on some of the terminology that gets used. For example, twisting, rebating, churning, misrepresentation, and laddering. These are different terms that are used when an insurance agent sells a product that either isn't fit for the client or it's for the benefit of the insurance agent more than it is for the client, right? So it benefits the insurance agent and not really necessarily the insurance company. They do get a win, but not so good when policies get canceled, surrendered. They don't, live out what it's supposed to do. So it doesn't look so good on the company long term. In the short term, yeah, profits, wonderful. For the insurance agent, yeah, short term, high upfront commission, great. But in the long run, I believe the best ideas typically win. So being able to sift through all of that is very important. So you as a client, you want to get familiar with these words: twisting, rebating, churning, misrepresentation, and laddering. So in regards to, say, churning and laddering, this is in the neighborhood of like an insurance agent kind of convincing you to have multiple policies or using one policy to fund another policy. Now, there is I've listened to some other YouTubers out there explain this, and I have my own approach to it, where I do believe there could be some legitimacy in it, but it's important to understand like when we get into a bit of a gray area. So if an insurance agent sells you on one policy, say an IUL or a whole life, and you buy it, and you've had it for, say, 3-4 years, and they come back to you and they say, hey, you've got some cash value built up in there, let's get a second policy. Now you're going to be earning a guaranteed interest rate on 2 policies, and we're going to use one to fund the other, and you're going to have a whole bunch of money later on in the years, whole bunch of death benefit, yada yada. That's a little suspect to me because of the upfront cost of insurance, right? Between whole life and IUL, it's very expensive in the beginning years. So you can come into an issue if you don't have the capital to keep these policies alive, right? So I think that would be a form of churning. Or another word is laddering, where they're getting you to use one policy to fund another, to fund another, to fund another. That typically I think would work well if I'm also an agent receiving a commission. Then maybe. But as a client, I don't know. You better be making more money to support that. The way I took it was I said, well, all right, if I'm dealing with a family, say a household, what if I work with the husband, he gets a policy in place, and then down the road, maybe a year or 2 years after, then we get wife on board. Okay, now we get her insured. And then as their income grows, then they say, okay, let's get the kids insured. Let's say they got 3 kids, 2 sons, 1 daughter. All right. Well, they put a policy on each of the kids. And then let's say once they've insured the whole entire kingdom, what I call it, or the whole entire household, and they're making even more money. They've 10x'd their income, or if they 5x'd, or their investments exploded. They got a windfall of cash maybe. Somebody died in the family and they got a big death benefit. Only then would I say, okay, maybe we can come back to husband or wife and get a second policy. So that's kind of like my approach. Based on that right there, between Joe, James, Dimitri, any thoughts there? Have you experienced anything like that from insurance agents, or maybe have been taught, that could very well be the case as well. I want to get some insight there. I see James on mic, so you can go, and then maybe Joe or Dimitri next.
Thanks. Yeah, I'm kind of in the same boat with you. I think that there's a lot of advantages to having all the family members insured before you start getting multiple policies on any one person. As far as the whole scam aspect, I've seen so many either just poorly designed policies or poorly designed for what their goals are. And a lot of that may stem from, there's a lot of agents out there, a lot of new agents, and agents just don't get taught how to properly design a policy that maximizes the client's benefit. And a lot of that is in the self-interest of the IMOs or the FMOs. Those are the marketing organizations that kind of stand between the insurance carriers and the agents, the individual agents. And then, of course, the insurance companies themselves. Nobody trains people on how to minimize the agent commission in order to maximize early cash value. Now, that's not the only way a policy can be designed, and not necessarily the only way it should be designed. I happen to put a lot of value in high cash value up front. I consider that liquidity. When we talk, the scam part basically comes in that we're talking with a lot of people that are not millionaires. They're not halfway to being millionaires. And, people want to do what rich people do and get into their position. And one of the things a lot of wealthy people do is they have extra money to be able to fund these accounts, and they don't necessarily need liquidity right out of the gate, because if they run into a financial problem, it's not going to be big enough. It's not going to be big enough to destroy their whole plan, right? They're not going to have to cancel their policy or stop funding their policy or let it lapse. Whereas people who are not that well off, but they want to get started, and an insurance policy is a great way to start building your financial base. It's safe, it's liquid, it helps cover an insurance portion and provide some safe growth. So there's a great place for it in anybody's portfolio, but we have to do it properly. We have to design it so that it fits their situation. And I see so many policies that are designed not to do that. That are designed to pay out the maximum commissions. It has low liquidity, may not break even for 15 to 20 years. And these are the people that tend to lapse their policies. They give up on it. They can't afford to wait. If they stumble financially in any way in the first couple of years, they're suddenly out all of the money that they put in to fund it. And those are the people that are going to be some of the loudest voices out there saying, that was the worst product I ever owned. What a scam. The insurance agent made all the money and I got screwed. And designing the policies, all the people that I talk with and the people that I work with, when we design the policies to have a tremendous amount of cash value right out of the gate, I shoot for usually 90%, right around 90% cash value in our whole life policies. Of course, it depends on which carrier we're going with and how we can design it. And then with IULs, if it makes sense, we get as much as we can, but usually 60% or more. With that type of liquidity, it allows people to encounter some financial difficulties, even if they're stretching to fund a policy at a very high amount, which, Nelson Nash, he talks about putting all of your cash, all of your income into policies. What a lot of people miss is he talks about getting to that point over a number of years, not right out of the gate. And I encounter people who are trying to do that right out of the gate. That's a challenging thing to do. So I think there's a lot of lack of education on the insurance agents' parts, a lot of incentive for them not to educate themselves, or a lot of incentive for them not to be trained that way from the people above them. And it ends up making these products that can be really, really great into a potential scam. I'll leave it at that.
Thank you for sharing that. Joe or Dimitri, have anything else to add to that? Because I'm going to follow on with this to really dive into when we can identify us as a putting on the client hat, customer hat, take off the insurance agent hat, helping people really be able to read these illustrations, read policy contracts to determine whether or not am I following the concept or process correctly, or is this as valuable as I think, or is it just a traditional IUL or traditional whole life? Because those exist too. That's a strategy, a very, I'd say, popular strategy. So anything you want to add to that?
Yeah, and to piggyback on what you said earlier, as far as the churning, when you're dealing with the multiple policies and how they're structured, one of the very most important things that I can automatically out the gate identify is the ability to do what's suitable for the client, and having the know-how to figure out what's suitable, even if it's not something you are completely 100% geared and to know a lot about. We as agents, I've learned over the years of dealing with other agents and policies that I've had to analyze, when I sit down with a new client, is that they put to products that did not fit the initial goal from the beginning. And that's one of the hugest pet peeves for me, is to be able to look at a portfolio, sit down with a client, no matter the income level, whether they are, a six-figure earner or maybe like less than that, or if they are one of my business owners that make multiple six figures or seven figures, regardless of what the income level is. If we're sitting down and we're looking at where you were 5 years ago when you bought this whole life or this IUL or this term for that matter, what was the goal at that time? And lots of times what I'm finding is that agents are putting clients into a policy that they have access to, or they know more about, or possibly never had the ability to go beyond that, or maybe the company that they're working for, if they're a captive agent, don't even offer what the client is asking for, but they give them what they have. And that puts consumers, it puts applicants, it puts the insured in a very, very sticky situation where
Starting to
we come
break up
across
on us,
another
Dimitri.
agent
Starting to break up.
like us on this. I'm sorry. Can you hear me better now?
Yeah,
It puts
repeat.
us in a position where we
There you go.
Go ahead. I'm sorry. I had to move around a little bit, maybe where I'm located.
Yeah,
But it puts
repeat
us
the
in a
last
position
10
as
seconds. Last
agents.
10, 15 seconds. Repeat.
Last 10 seconds? So
Yeah.
the last 10 seconds of what I said was, when you're working with a client and you come across a new agent or another agent like we, the people here on this panel that have the experience in working with these type of products, if they've been put into another product that never, ever fit the goal, was never part of the original plan, they just got fit into something that was available with that agent at that time, it also puts them in a position that now they have to try to correct what went wrong. And when you're having to correct what went wrong, you get into this position of having to rewrite something or try to fix something when the goal was never met from the initial meeting of that agent. I see that so often in this industry of sitting down and auditing portfolios and profiles to see, okay, where were you 5 years ago? Let's evaluate to see if we've hit what you wanted to hit in these last 5 years. How have we progressed? What do we need to do now? Has the cash accumulated the way we anticipated? If it did not, what went wrong? And so what I say is, when you're dealing with something like churning, and that was the question that you had presented to the floor about the churning, there are actually clients out there that have been put in a position to have to get additional policies and change up policies from other agents because the goal that was set initially was never really met. They just trusted that the policy that they received would fit what they asked for. And a lot of times that's not the case. If you are an agent and you are in the maybe in the audience today and you're listening, my first indication that I know that you are an agent that know what you're doing is, are you sitting down with the client to ask the questions? What are we trying to do? What is the goal? Are you trying to create an income stream? Are you trying to use it as a cash flow account? Or do you have other means of diversification? Do you have some money to put aside for emergency fund? Are you going to overextend yourself on this policy? If that's the case, let's reevaluate. Is this a comfortable payment for you? Those are the type of questions as agents of what we do is supposed to help the applicant, help the client make really good decisions. So when you were mentioning about, trying to realize if this is going to be the good fit or if this is a scam, what happens is that people get scammed out of doing policies that did not fit the mold. And so it's important to make sure that what you have in front of you and what you're presenting to your applicant and to your client actually does fit what they're asking you for. And if it's attainable, look at the illustration, explain the illustration into the break it down into the smallest morsel of terms so they will understand what they have in front of them and if it makes sense for the goal that you've got in mind. Back to you.
Thank you. Really appreciate that, because I'm in a situation now where I have a potential client. Lady reached out to me. She's in her early 60s, I believe, has a whole life with Mass Mutual, and then has 2 guardian policies on her 2 sons. I believe they're young boys. I'm not sure their ages yet. So before I even, accepted her, I said, hey, send me your policies. Let me see what you have. Let me see how it's designed. Send me the full policy contract, not the regular illustration. I want to see the breakdown, the premiums, the cash allocation, all that stuff. And as I read through, I said, okay, this policy was designed almost in the neighborhood of a 50-50 split, meaning 50% of her money, she's putting in $40,000 a year into a Mass Mutual policy. I believe she established it at the age of 60, and she's 2 years into it. And so she's already paid in $80,000 total. She has nowhere near that amount in cash value. And she came across my content, some other people's content, and now she's growing concerned. Say, hey, I got this policy. I wanted to put more money in, but then I'm told that I can't, that I'm going to create a mech because of X, Y, and Z. She was like, I was watching your content, and according to your content and other people's content, they're saying that they're able to put in more money. And so that is very true, but it only depends on how the policy was originally designed and for what purpose. So Dimitri brings a great point on, that preliminary pregame work that is required, and really understanding where the client's at. Now, I'm pretty sure this client, this woman, if she has the ability to put $40K in, and she's telling me, hey, Denzel, I want to be able to put in more money, but I'm told that I can't, that I'm going to create a mech. Well, I'm assuming she's doing okay in her 60s. Now, the issue becomes of her, insurability, health, did anything change in the last 2 years? I got to figure that out. I need to get her numbers. I need to know her 4 major numbers. It's something I always discuss on my channel, is knowing your numbers, front, back, up and down to the penny. And then not only is it important for my client to have a good understanding of the concept of infinite banking, becoming your own banker, but also what is the strategy that's tied to the product of whole life or an IUL? What is the additional features that we're going to be adding into the mix? And so if we get a clear understanding of not only what product we want to go with and the concept itself, but also what are we going to do with the policy? Because to just overfund a permanent life insurance policy and just watch it sit and grow, I mean, that's okay. But if we want to kind of supercharge it, if we want to add some more velocity to it and get multiple uses, there are very many other ways that we could, position ourselves to accumulate additional wealth with the same dollars, right? So being able to have that discussion before the policy is in place, I would say for me, roughly this is about a 2 to 3, almost 4 month process on average when I'm working with my clients before they actually put a policy in place. So I may not get paid personally 5-6 months later in regards to when I'm working with a client one-on-one, because I have a very extensive process because I want to limit failure as much as humanly possible. And I also want to go over worst case scenario. Hey, worst case scenario, if you can't hit 40K a year, 50K a year, what's the minimum premium that we can do with our eyes closed? Like, regardless, if I lose my job, I can still pay for this. And if I lose my job and I'm disabled for the next 2-3 years, or all hell broke loose, will the policy become a lapse, or can the cash value sustain the policy for maybe, say, 2 to 4 years? Yes, it's going to cause a delay. Yes, it's going to impact my cash value performance, of course, but the policy doesn't die. It doesn't become a lapse. And then if I try to recover myself and then get back in the game, but now my health is worse, the insurance company may not accept me. And then there goes that whole strategy, right? So you brought up some really good points there. I think Joe wanted to add to the conversation, but maybe take it from a different perspective. And I want to give you the floor to present what it is that you'd like to talk about there.
Hey, Denzel, I appreciate it. When I listen to you guys, and, one thing that I think I may be able to bring a little different perspective and is, first of all, I'm not a life insurance agent anymore. I no longer sell life insurance products. And so a lot of what you guys are talking about is kind of coming from a life insurance sales perspective and looking at things. But, when you start looking at the becoming your own banker concept, and is it legitimate or is it a scam? I think it's important for people to understand that how a bank works, and I think Dimitri talked about that a little bit earlier, just how understanding the banking system and how banks work, and now you've talked about how some of these policies are being layered on top of layers with the policies themselves. And, banks don't say, okay, well, we're now borrowing money from the Fed and we're going to go and start another bank with that Fed. We're going to create this bank and this bank and this bank. The idea of using a life insurance policy is a way to create a bank, but it's not the way to create your banking system. And, James, you and Denzel have both identified that there's many different ways to create cash flow, many different ways to create that that velocity aspect of things. And, I didn't give a whole lot of intro leading up because I was just trying to give a quick overview. But, I'm a former high net worth financial advisor. I ran a family office for a number of years and had nearly $1 billion of assets under advisement. And so, I've written policies as much as $750 million of policies for a legacy plan for a client. And I've simultaneously written policies for somebody just starting out to create the idea of creating their bank and getting their velocity going and setting up the the cash flow for them. So I've really worked across the board on that side. But for me, it's really about the strategy and looking at your situation holistically and saying, okay, if I'm going to leverage a policy, or I'm going to leverage a mortgage, or I'm going to leverage whatever the vehicle is that you're using, and say, okay, I'm going to use this as a way to leverage up into a banking concept and get my money working for me and moving for me, then that's great. You just need to understand exactly where you're going into and what's your cost of the money, and is it moving forward, and what are you investing into? And so it's all about creating the proper layers where you're borrowing from one place, and then you're creating arbitrage and increasing your asset value. And if you're just with somebody who is selling you a policy or selling you a product, I'm the CEO of Middle Class Millionaire LLC. Our entire mission is to do nothing more than educate and empower entrepreneurial minded, faith focused, purpose-driven people to achieve financial independence so they can pursue their God-given purpose instead of a life-sucking paycheck. So when I'm sitting here talking to you about banking, I'm not coming at it from an insurance sales perspective. I don't make any money. I've got no dog in that fight. My whole thing is trying to teach people how to grab a hold of the opportunity in front of them to get their money working for them and not for some other quote unquote professional. And that's where the scam part comes in. That's where the scam part happens, is when and you guys have talked about this, and I really appreciate everybody up here on the panel and on the stage as you guys are talking about making sure that it's structured properly. And that is very, very key to making sure before you get into a situation, preferably identifying what the policy is and where it is. But once you understand the system, once you've been taught the process, now you can go out and you can find the right person who can structure it. You have to understand, there are dozens of life insurance companies. There are hundreds of different types of policies. This isn't something like, oh, I got a whole life policy, or I have an IUL or an indexed universal life policy. There are literally dozens and dozens and dozens of different ways that this policy can be structured and focused depending on what the purpose is. Are you trying to increase your death benefits so that you can have a legacy plan? That's a different strategy than if you're trying to create a banking system where it's the most efficient possible, and you're wanting to have your death benefit as low as possible and your premium as high as possible so you can increase the maximum amount of internal cash value inside of that policy as quick as possible. Also, I haven't heard you guys mention this, typically a structure like this, before it really becomes super effective, takes about 5 years. And so this is not a short-term play or a short-term workaround. So, with that said, I just wanted to kind of come at things from a little bit different perspective. I hope that's valuable. Thanks, Denzel. This is Joe, and I'm complete.
Yeah, it definitely is. It really is valuable, because one of the biggest things that I had trouble understanding, this took me, I want to say, over a year, almost a year, before I started presenting Becoming Your Own Banker, Infinite Banking Concept, and selling policies. I spent a year really, studying this stuff and looking on the internet, and something wasn't clicking, where I was like, okay, I'm overfunding a policy. Okay, it's going to provide a death benefit. It has this guarantee. They're saying it's tax-free. It's going to grow compounded. The rates are fairly small. It takes 5 to 7 years, maybe longer, depending on how it's designed, for my principal dollars just to break even. And then maybe add another 1 to 2, maybe 3 years before you actually have 100% of what you put in, you're able to borrow out and use, right? So the biggest hurdle was, I say, okay, well, this just doesn't make sense. Becoming your own banker just doesn't make sense if it's just the policy itself. Like there has to be these additional components, which is the strategy, as well as a discipline component, a mindset component, understanding how to recapture dollars in my own personal economy, and so on and so on. There's so many moving parts. So I think that was one of the biggest issues I had when I was on the customer side of things, and then trying to make that transition to become an insurance agent and provide the products to clients and obviously make money from it and all that good stuff. So the way that I approach this in regards to, you know, the marketing terms, what Joe brought up about how this becomes a scam, and you know, scam is a strong word, right? Because that implies that, you know, there could be criminal, you know, charges brought up against that person, right? And insurance agents, it's a gray area. When we design a policy poorly, it's not really, we're not really at fault. We are at fault, but we're not the one that gets blamed because the client signs the contract. They agreed to that 100+ page document that they didn't read, right? So what ends up happening is the liability falls on the client, 100%. So it's very hard to you know, catch that insurance agent that's doing a bad job. Very hard, I would say, because just by understanding that when you sign a contract, that you're now liable. Okay, if the policy blows up on you, becomes a mech, well, it did say in page 47 under section 8 point blah blah blah, this policy will become a mech or will become a lapse when you're 85 years old, right? If you don't read that and you don't know how to mitigate the risk or remove it completely, we can fall into some issues. So Joe was definitely hitting on some good points there, and that's something that I struggled with when I was first became an agent, and still to this day, it's not easy to relay this information to people. You have to really dive into it. And if we take a look at the board, for those that are watching, I got 110 people watching on YouTube and maybe on LinkedIn and Facebook all combined together. I put some main components when you're looking at becoming your own banker that I believe needs to happen. You need to have this in place. And this is just the basic, right? So for me, understanding that life insurance is a insurance, it's protection, it's not an investment. So that's very important. So you should not be comparing your 401k or your stock market account or your Forex or your crypto against this, right? So I think that's the first thing. So this is not an investment, so you have to take off the investment hat. You have to think more protection. How do I protect my kingdom? How do I protect my income? How do I protect my savings? How do I protect my investments, right? Everything about becoming your own banker is about protection, I believe, at its core. So insurance, that's death benefit. So being mindful that that does exist and there is a cost for that. The other component is tax-free growth that comes with the product itself. It's an alternative to savings, okay? So we're earning less than 1%, nationally speaking, on bank accounts. So a life insurance product does beat a savings, money market, possibly CDs, even like bonds nowadays. So it does have that component that's with the product. Now, what's not with the product, whole life or IUL, is the strategy part, which below I talk about, which is recapturing costs. So to give you an example, me personally, here are my numbers on the board for 2021, roughly 25K a month in revenue, 10,000 a month in expenses, bills, zero debt, 10+ thousand in cash flow. So when I break my numbers down, when I fund my policy, I am funding it with savings dollars, money that I'm not going to touch. That's one. The second is money that I'm going to spend regardless of what happens. I still have to pay car insurance. I still have to pay health insurance. I still have to pay, my phone bill, all the products and services I use to run my business, food, clothing. These are all things we all have to spend money on, regardless. So what I do when I fund my policy with real dollars, cash, right? It sits there. I then borrow out a portion of those dollars. And I have a rule. Me personally, I do not borrow more than 66% of what I have in cash value. That's like my rule. The reason why I do this is because there is a loan interest charge when we borrow money against our own money. So the minute I take money out of my policy, I'm paying interest. Simple, daily, accruing, compounded interest, right? That will compound yearly for however long I leave the policy loan outstanding for. It's very important to know that your loan interest will compound year over year for however long you owe money on your policy. At the same point in time, you're also being credited an interest rate. It is a gross rate. This is very important. You're getting a gross rate. So let's just say the loan interest rate on your policy is between 5 and 6%, and maybe the dividends of that insurance company is also in the neighborhood of between 5 and 6%. So in your mind, you're thinking, okay, that's a wash. Well, yes and no, because in reality, there's an internal rate of return. After all the insurance expenses are paid, mortality charges and whatnot, especially in the beginning years, you're getting a net internal rate of return, which is likely, not likely, guaranteed to be negative in the first maybe 1 to 2, maybe 3 years, depending on how your policy is designed. So no matter which way you're looking at it, you fund a policy, you're negative. Meaning, so in my case, I'm funding a whole life. I'm putting $70,000 a year into it with a company called Guardian. So I put 70 grand in. Day one, my cash value was 60,000 and some change. So I'm in the hole $10,000. I just lost 10 grand. I put 70, I lost 10. That doesn't make any sense, Denzel. Why would you do that? Right? So these are good questions to ask. So let's work through it. And if you get an insurance agent that's willing to do all this with you, I think you're on the right track. You're working with somebody that genuinely wants to, see you succeed and see you win, along with all your other investment strategies that you're doing with your money, your cash flow and all that. So if we are being charged an interest rate on our money and we're negative day one when we put the money in, we have got to make sense of that right there. Does that make sense for me to put money into something and immediately lose money, right? And I think, in my mind, I think as a business owner, I'm like, well, when I first started my business to start a YouTube channel, I put money in, I was negative for the first 6 to 9 months, or not really, for the first 4 to 6 months, I was negative. I was in debt. I was trying to build, right? I was trying to work my way up. Even with crypto investing, when I first put money in, it went down. Every time I bought, it went down. And then 6 to 9 months later, I'm like, I should be a crypto millionaire in the next 2 to 4 years. Who knows? But when I look at any investment I ever made, or when I invest in businesses, when I invest in myself, there is a bit of a negative period. But then you look at the long term and you say, okay, there's a positive gain in the long term. Now, there are definitely investments that should not be negative day one, meaning you put money in, it cash flows immediately, right? I think real estate would be a good example. You do not want to be negative, right? Day one, right? You do want to produce some cash flow that shows numbers long term. You also don't want to be negative for too long, which is why when we're looking at insurance, you got to take off that investment hat, because you're like, wait a minute, I'm losing money. This doesn't make sense. I put 70 grand in, I lose 10, right? And in some cases, depending on how your policy is designed, you could be in the hole 20, 30, 40, maybe 50 grand, right? I've seen policies where people were funding nearly as much as I was, and they've got 50% of their cash going to cost of insurance premiums, and the other 50% to cash value. So they're very illiquid. They really can't use the money for much. They got to let the policy, cook and grow over time. So that can be a very tough conversation to have. So for me, when I look at the components, I say, okay, well, how do I make sense of losing 10 to 16% in the first year? And the only way I made sense of it so far is how I use the loan once I take it out, once I put it into use. So for me personally, when I put in 70 grand, I take out 66%. 66% of 60,000, my starting cash value was right around 39 to 40K. So I take out 40 grand and I fund an HSA, health savings account. I fund a Roth. I fund an investment account, right? And then I put money into other safe locations, or what I would call safe locations that can produce more cash flow or rate of return. So in my HSA, I'm buying gold and silver, right? In my HSA, I buy gold and silver. That is a hedge against the loss that I just incurred. In the Roth, I'm buying dividend paying stocks, index funds, zero cost index funds that should yield me 6 to 8% returns, hopefully, okay? Over, an average period of 30, 40 years, whatever the case. So I'm getting 6 to 8% there, right? And then the gold and silver, maybe that will yield maybe 3, 4% yearly or something like that. Who knows? So I'm getting a rate of return there. I'm also getting a deduction on the HSA when I fund it, so I'm recapturing a tax expense there, right? I'm recovering costs on the tax side. Okay, cool. Then I look at my living expenses and I look at all of my guaranteed bills that come out every single month, and I switch from monthly to annual, and then I also see if I can run that bill through a credit card that's going to earn me in the neighborhood of 3% cashback rewards. So I'm going to earn 3% roughly cashback on bills running it through a card. When I switch from monthly to annual, in my case particularly, I'm saving 15% of my cost of living on average for the whole entire year. 15%, sometimes as high as 20% on subscriptions and bills and things like that. So 15% plus 3% plus this 4 to 6 plus the deduction on taxes. Now we begin to say, okay, wait a minute. This guy is using money that was leaving his economy already, putting it into this banking system, which the money will be there no matter what. It's guaranteed, backed by the death benefit, backed by the insurance company, and how insurance companies are regulated. They're not able to do fractional reserve lending like the banks are. So they have more regulation there. So very, very safe place. We understand that banks also do this via BOLI and COLI and EOLI policies. So EOLI, BOLI, and COLI. They're doing it. Got it. In my own economy, I say, all right, if I got these components in place where I'm using the same dollars that I would have funded my HSA, my investment account, my crypto account, my gold and silver, and my living expenses. This is all money that's going to leave my economy. And then I use my savings dollars to cover the cost of the insurance. In case I die, boom, death benefit gets paid out, $4 or $5 million. If I lose my job, or say my YouTube channel gets canceled, shut down, I lose a big portion of my income, I've got access to my savings dollars if anything goes down. Okay? So I think this was one of the biggest things I struggled with as an insurance agent. And I said, well, the only way this thing actually will work, in my opinion, is if we have all these different components. And this took me a while to explain it, and I really didn't even get into it. I just kept it on the surface level. So this could either push people away, or it actually brings people further in. They're like, whoa, this is a lot. This is intense, right? But in regards to creating financial freedom, financial independence, I don't think it's a walk in the park. I do think it requires a lot of, mindset, discipline. People, average American income, I think, is around 50 to 60K. In many cases, becoming your own banker does not make sense for a majority of Americans in the position that most Americans are in. So they come across this concept, they fall into the hype, they start a policy, and they forget, oh, wait, I haven't even saved, like what Dimitri was saying earlier. Don't even have an emergency fund built yet. I'm still, 400 or 500 grand in debt. The creditors are calling me. I can't sustain, a good spending habit. My budget is all. I never stick to my budget. What makes you think you're going to fund a high cash value life insurance policy for 10, 20, 30, 40 years without the good habits of money? So, Joe, you brought up some really, really good points there. Let's see. Dimitri, I think you were just messaging me, you wanted to add there. Go ahead.
Yeah, and bravo for you actually breaking that all the way down, because you made a very valid point. And just to piggyback on what we were talking about earlier, and to acknowledge what Joe was talking about earlier, it's not about product. It's not about product. It is about systems. It's about strategy. And it's about sustainability. And what you just gave is an example of how to actually use that in a way where you are making sense of every penny on the dollar. Because I come from the banking industry and most of my background is in banking, I know the systems of how the banking institution uses our deposits, how those deposits that sit there for a brick and mortar building, whether it be, Wells Fargo or Wachovia or Deutsche Bank, whoever it is, and how those particular savings and checking accounts, those particular deposits that sit there on a nightly basis are swept in for what they call sweep accounts. And the banking institutions are able to use those deposits into that particular account to invest overnight to receive interest back to them. So because I used to process those accounts, I have the idea of what it actually does in the system of the banking industry and how we are, whether we know it or not, we are participating in the system of how to do that. That is just the way banking systems work. So what you just basically explained, Denzel, is how to use that same concept in your own home, how to use that same concept into paying your day-to-day bills, and to also be able to leverage the returns of using your business card and those cash rewards that come back to you, to be able to leverage all of the information that you just gave on why it makes sense to do certain things and not others. Another valid point that I think it was Joe that brought this up earlier, that when you're dealing with infinite banking, it's not an overnight item. Absolutely not an overnight concept to persuade. You basically have to put in systems 5, I say 10 years. Some say 7 years, but I give it the worst case scenario to 10 years of letting it actually do what you really, really wanted to do. So I just want to really just give you a shout that was a really great explanation of how to use the systems, the strategy, and create sustainability. And it's not about the product, and it's not about the sale, and it's not about the insurance company that you use. It is really about the options of how to utilize and leverage every single dollar that comes your way. And so I just wanted to give you that shout that you did an excellent job in explanation.
Thank you, Dimitri. I appreciate that. Yeah, you know, as much as I love this concept, I'm constantly reminded by the clients that I serve on the consulting and coaching side of things, where people are just trying to get out of debt. Some people are just trying to get their credit right. Some people are just trying to increase some cash flow from, you know, they're working with $200, $300, $400 cash flow, and they're just trying to get to like $1,000 in cash flow or higher than that, or trying to increase their income. So I do believe that this strategy works very well if you're making a lot of money, without a doubt. I mean, it's just a matter of allocating a portion of your savings and money that you're going to spend year over year. The other day I went over an example of how, you know, someone could fund a policy with savings dollars plus money that you're going to spend on your medical costs for as long as you live, right? I think in the United States, I think the average health insurance cost per month is in the neighborhood of $500, right? $400 to $500. So you times that by 12, times that by 30, 40 years, and then times the co-pays, the times that you end up in the ER, urgent care, the times that you get sick, the blood work and all the other things, the prescriptions. You add all that money up, imagine feeding that into a policy and just having the money sit and grow forever and ever, for as long as you live, obviously, and then using the same dollars to pay for the expense, and then running it through a credit card to get all the cash back rewards. So we're solving for multiple things: cash flow, building credit, maximum efficiency, lowest cost output. We're recapturing costs, and it allows you to build an economic system in your household that is, market crash proof, crypto proof, real estate proof from whatever happens globally or just here in the United States. Typically what happens in the United States, typically on a big scale, will affect many other nations, many other countries. So just being able to understand, just, okay, at the individual level, no matter where I'm at, let's make sure we get our numbers right. I know that just by doing the math, understanding, even the people on Clubhouse, the 130 people now watching on YouTube, 50% of you are living paycheck to paycheck. Like, this is not an argument, right? 50, roughly 70, maybe even more, are living paycheck to paycheck. Don't have more than $1,000 in your emergency fund. You can't sustain a long-term relationship with your money because you are spending it, wasting it on the partying, the intimate relationships, the gluttony, right? You're overfeeding yourself. You're eating too much, eating out too much. The Uber Eats, all of this has to get solved, or at least reduced, mitigated, under control before we exercise this wonderful concept. Because if it's introduced too early, it can either become a scam where you get misguided by the insurance agent, or the product was poorly designed. You have all that to worry about. But then the client themselves, what if you do come across a really good agent? They design a really good policy, right? It's gonna have high cash value. It has guaranteed growth. I mean, this is the best policy. It's with, if there is the best company, let's just say there was. Okay, boom, you're with the best company, the best guarantees, the best dividends, the best everything. But you have not consistently saved money. You haven't tithed. You don't give. The minute you win some money, you get some money, you spend it the next day, you're paycheck to paycheck. the concept will not work. It just won't, no matter how good the product is. So there is that aspect, the human error, and then, the person that you're working with, the insurance agent, the concept that you eventually will put in. So with that being said, anybody on Clubhouse want to raise your hand? Now's the time. If not, I'm going to look at the YouTube comments and questions that are coming in, because I got 130 people over there watching live, as well as I'd say a good 30 or so people on Clubhouse. So if you're on Clubhouse, you get priority right now. If you want to go ahead and raise your hand, ask a question, you're going to get priority, because I can have a conversation with you, and maybe Joe, James can tune in, or provide some feedback. All right, I do see one hand got raised. Mr. Devin, if you don't mind, just introduce yourself, a little background, what do you do, and if you have a specific question, or if you just want to comment on the concept, whether you agree with it or not. I give you the floor.
Hey, thanks, Denzel. So I've been actually watching your content for a bit, and I went through the process with my insurance agent, financial advisor, whatever you want to call it. I think it's sort of insurance in the beginning, financial longer term, but it's neither here nor there. Basically, I decided to go to pause on the whole life infinite banking and getting started in it for a couple of reasons. So, one, I'm W-2 employed right now, in the process of building, a good healthy base of recurring revenue through outside consulting. Probably, give or take, cash flowing about $4,000 a month right now after expenses and everything. But my primary question for you, and I'd just be super curious on everyone's opinion. We still have student loan debt and car debt. I think I could knock down that pretty quickly, wouldn't be the right word, but aggressively. And instead of moving forward on a whole life 99, where it was like a 10% premium, 90% cash value split, I actually used some of IBC Global's concepts to get my insurance agent to go for lower whole life death benefit, higher cash value with the 1-year renewable term. But I got kind of conflicted around, one, my wife and I decided that she was going to leave her job, work with me on the business, and take care of our son. And I'm kind of planning my exit strategy around my W-2 to double down on the consulting. And my primary concern was not that we wouldn't be able to fund, but that funding a whole life policy may not be the best first step versus aggressively tackling debt. I'm just curious for thoughts around that.
Yeah, and I welcome other speakers here on the panel to definitely chime in if you heard his whole entire question. So a couple things before I just answer right away. You said you've been watching my content for a while, and typically I do put things in a bit of a chronological order, where I'll mention Dave Ramsey, Debt Snowball, Debt Avalanche. If the focus, according to Devin, according to Jeff or Noah, Lola, Emma, Scott, Sela, Eric, all the people that are in here right now, if your goal, you personally, not what Dave Ramsey said, not what Grant Cardone says, not what Tony says and Warren Buffett and everybody that you don't go home with at night, like you go home with yourself at night, you have to look at yourself in the mirror. What is it? What is your purpose? Who are you? Where are you going? Where are you headed? Where you want to be? Once we've answered those questions, if paying off debt is the most important thing, or you know what? Wife said, I want to pay off some debt. And we all know happy wife, happy life. Listen, I rather, you know, have a happy, satisfied woman and a secure household than an aggravated, frustrated, annoying woman telling me to pay off my debt, but I'm trying to do something over here that she don't understand. And, you know, there can be some conflicting, you know, if I can't get on the same page with the person that I'm going to bed with every night, that's a problem for me, you know? So let's settle all that first, in my opinion. Now, if paying off debt is the most important thing, IBC is definitely not going to do it the fastest way. I will, me personally, I've ran a bunch of different scenarios. I don't see it. Maybe if I have higher income, maybe. But cash flowing 4K, I'm assuming I got pretty good income. You know, what's that? 40, 50 plus thousand a year in cash flow on average, conservatively speaking. And you said wife just left her job to help you on the business and you want to exit the W-2. Okay, cool. We got a lot of moving parts going on here. I would consider debt snowball, debt avalanche first. Take a look at that. That's my measuring stick, which I will compare against velocity banking, which I'm pretty sure you say you've been watching my content. So you're on that a little bit. I'm pretty sure you came across it. If not, I use debt snowball and debt avalanche as a measuring stick to determine whether or not velocity banking, which is using debt to pay debt, right? Using a credit card, PLOC, HELOC, all-in-one loan, whatever it is, to accelerate paying off debt. So debt snowball, debt avalanche are the most popular ways to get out of debt. Couple that with minimalists and frugality, couple that with, you know, cutting back on stuff and selling stuff and side hustle. That's all added on, right? But the fundamental of paying off debt, extra payments, right? A cash flow every month, boom, pay that towards the smallest debt, work your way up, or avalanche goes after highest interest rate and then so on and so on, right? That's your measuring stick. If it says, okay, you'll be debt free in 3 years, according to that, that is a very good measuring stick. Boom. Now, velocity banking has to beat that by, I would say, at least 30, 20, maybe 40%. You know, I would like to be done in 1.5 years. You know, that's 50% faster if it said 3. So if velocity banking can beat that snowball and avalanche, then I'll consider velocity banking, right? So that's kind of like where I'm at. If the focus is to pay off debt, pivot into your business, reposition cash flow, make sure you got your, you know, your safety net going on, your, you know, emergency fund, whatever helps you sleep at night, get that all in place. Okay, great. If paying off debt is not the focus and you're trying to just pivot in the business, reroute your income from W-2 to the business and build that out, then I would also agree with, you know, putting IBC on hold, right, and focusing on 10X. Let's say you're, you know, leaning towards Grant Cardone methodology, where you're like, look, debt is money, paying off debt don't make no sense. You know, if you're leaning in that realm of things, okay, great. We take the Grant Cardone approach, which is to 10X everything. 10X our mindset, 10X our thinking. We want to go big. So if I'm trying to make, you know, 15K a month, if that's the goal, you're supposed to times that by 10. And even if you failed miserably and got to 2X, that's 30K a month, I'm sure you wouldn't be upset, right? So it's that whole mentality, that mindset. Based on what I said so far, am I making myself clear so far to you, Devin? Is that helpful so far?
Yeah, absolutely. So, yeah, I'll say I'm glad that instead of moving forward with the whole life, we just went with I think it's a 10-year convertible that's like, you know, pretty cheap every month, and I can at any point I should be able to convert.
That too, just getting a simple term, right? Yeah, I agree with that. I had a client do that. She was looking to put in 40, 50K a year into a policy because she got a windfall of cash. But I was like, whoa, wait, hold on. You got a windfall of cash, but you're not making that a year, right? She was only making like, I think she was making like 30, 40K a year, but she got a windfall of cash. She wanted to throw it all in a policy. I'm like, hold on. let's get our money. Let's put some other things in motion before we, you know, jump the gun on this. So Dimitri, would you like to add to Devin what he was saying earlier?
Sure. Devin, you made me stay on a little bit longer. I was getting ready to jump onto a call, and I said, hold up, I got to address that.
Thank you.
Devin, you made some valid points. And the whole thing of the first two lines of what you described of where you are and the chapter of life that you're currently in tells the information of what direction you really want to go. And if you think back to what you said, you were talking about how your wife decided that she wanted to come back a little bit, take care of her son. You're leaning towards exiting, creating your exit strategy on the W-2s, right? You have a lot of moving parts, like Denzel just said. With those moving parts, what you want to keep in mind is the sustainability part. Remember earlier when I was talking about system, strategy, and sustainability? Sustainability part is going to be the area where you feel that you can comfortably put money into a product and continue it on without it being a struggle to your household income, to your lifestyle, to you being able to do things
Comment
with your family,
if you
like
guys are
vacations,
enjoying this,
and possibly invest in some other things that you're really passionate about. If the system is off, if the strategy is off, or the sustainability is off, then that means you need to relook at the idea. So you made a really good choice into holding off on that at the moment until some of the other things can level out for you, okay? Such as the maybe the income increasing a little bit on a month-to-month basis. Perhaps if your income is about to shut down a little bit more because your wife is going to knock off some of her work and come home and take care of the son, that may change your livable income at the moment. So all of those things are important when you're doing this. And this is what I call a suitability analysis. So when you do a suitability analysis and you get a chance to see what you have in income, what you're actually living off of versus what you're actually spending in miscellaneous money. What type of investments do you currently have? Are those investments moving for you? Let's talk about your debts. Do you have a house note? How much are you putting into your mortgage? Do you have credit cards? Do you have all those other things? When we look at what you have in income versus just your cash flows versus what you're pulling out and taking out on a month-to-month basis, if putting money into a policy like a cash account or IUL or a whole life for that matter, if it's going to overextend you, then we need to revisit it at a later date when those things have leveled out for you, where you have more cash flows to work with without it being a drain on the household. Does that make sense?
Yeah, that was my thought exactly. I didn't want to add a constant into a situation that is likely to be very, really variable over the next year or two until I can stabilize the business.
Exactly. And so once the business starts to stabilize and your profit and loss statements appear to be a little bit more level, and that maybe, you're not going up and down and it's not very variable, that can sort of make a big difference. And I tell people all the time, I work with a lot of business owners, what's going on in your business can slowly bleed into your household, okay? So if business is, doing well, but not as well as you want it to be, not to the point where you can put $40,000 and $50,000 into whatever you really want to put it into, then you want to draw back just a little bit, work on a 12 to 18 month plan before you jump into something that you don't feel like you're going to be able to consistently sustain. Okay. And that's all I want to add, Denzel. Thank you for the floor.
Thank you for spending all this time with me. I really appreciate it. Really enjoy having conversations with you on the phone and all the things that you're working on. I'm excited to do more collaborations with you long term. I know you got to go, so I will say goodnight to you and, be safe. And I look forward to the next interaction. I got one more hand raised, and then I'm going to go to my comments. So for those that are on Clubhouse, your priority. For those that are watching on YouTube, you just, go on your phone, open up the Clubhouse app. If you don't have it, download it. It's free to join now. It's open to Android and iPhone users. You don't need an invite or nothing like that. They opened it up to everyone, and you just look up the room. It's titled the same as the YouTube channel title, and then you can hop in, ask your question, and we'll go from there. So next up we got Robinson. Hello, sir. It is a honor and privilege to get to talk to you again, and I'm going to be attending the Vault conference. It's going to be at the Diplomat Hotel in South Florida, so if you want to meet in person, because I know you're also in South Florida, maybe we can arrange something. It'd be really great to bounce some more ideas off of you on the real estate side. I'm getting closer and closer. I've been saving my money up. I've got roughly 150K saved for real estate, so I'm just very cautious before I jump into real estate investing with everything that's going on. I'm still trying to learn it all. But a guy like you I know is willing to help and serve. So with that being said, go ahead and introduce yourself and anything you'd like to add.
Thank you, Denzel. Thank you for the introduction. It's always a pleasure to be with you here. And of course, every time that we are in the room, I'm learning every single day. Thank you for the content. My name is Robinson. I'm a real estate investor here in South Florida, West Palm Beach area. And I recently, after actually start following you last year, I got my policy on place. I think we already discussed in other rooms. But I have a question on reference a possible new policy in the future, because I think I jumped so quick on this, but I could have done a little bit better on this policy in terms of the way that I did it. So the question is, I know that you can also can get a policy under your LLC. With that said, if I get my policy under the LLC, and we are two partners, in this case, my wife and I are partners of the same company, and one of the partners pass away, let's say, the policy, since it's under the LLC, it goes to the LLC. With that said, one of the partners will be the beneficiary of this policy. Am I correct?
It would be you or wife? Correct.
So at the end, she will get the benefit of the death benefit. I'm talking about the death benefit of the policy. Am I correct?
Yeah.
Okay. So, and the second question would be, in terms of funding the policy, I funded the policy and immediately took a loan to buy another property under real estate, without even getting to my peak of the policy. I mean, without funding the entire amount of the policy. So I start funding immediately. Instead of paying the debt that I have on the policy, the loan, I decided to max out my policy right away. Is that the best way to route this money, or should I pay my loan first and then fund the rest of the policy? That would be the question.
What was the what's the max amount funding for that policy?
The policy for $80,000.
Right.
The max with the MEC is close to 93.
You went with Guardian or Mass?
Yes, Guardian. 92. Yeah, it's a 90-10 policy.
Yeah, and you're only 1 year in, right? Or approaching the second year?
I'm approaching the second one, yes, on September.
Got it. In the first year, did you pay an 80?
Yes, I funded.
Got it. So you fully maxed it.
I just funded actually the $80,000 a month ago.
Okay.
I'm thinking because I'm also paying my monthly premium every month, so I didn't put the 10% right away. So I'm just paying the monthly premium every month.
Got it. So you have max funded for year one, but not year two, up to the 80K, correct?
Correct.
Got it.
Because it's not due yet. I mean, it's
Right.
on.
Right.
at the end of September, November, I guess, is the first day of
Right. Guardian allows that flexibility where you can just add in cash at leisure at any given time as long as, you know, you pay your premiums, right? So right, we get that part. Okay. And how much do you have in loans currently?
close to 35,000.
Okay. Do you, right, so you did 35K in principal, right? How much, did you pay any of the loan interest yet or no?
Not yet.
Got it. Is the 35K a part of the loan interest, or is it 35K principal and then there's also loan interest? Like what is that amount?
It's part of the
Part of the 35. Got it.
yeah.
So it's principal and interest at 35K. It's principal and interest. All right. So here's what I did personally with my policy. I'm in my 3rd year now, so I've put in, you know, 70K each year, and so that's a total of 210,000. Yeah. In principal, I have just under 70,000 in loans, and I'm getting ready to borrow out another 30 to 40K. What I did was I paid my loan interest. I went ahead and just paid it. I'm earning so much in these other locations, especially in my crypto account and my investment account. Stocks have been doing really well for me and whatnot. So I just, you know, took all those gains and I decided to pay the loan interest instead of letting it compound. So that was the first thing that I did. I do agree with max funding over paying back the loan principal. So if I have the ability, based on my income, expenses, cash flow, if I know I can get to the max 80 for year 2, and even get to a point where I can, you know, fund it in one shot, that would also save me money on costs instead of, you know, spreading it out over a monthly or quarterly or semi-annual basis. If I can get to that point, that does improve the policy performance on the cash value for sure. When you compare people who fund their policies monthly compared to those who do it annually, people who fund annually do get rewarded because they're, you know, funding it up front, and the cash starts to grow day one, right, from that point on. So I do agree with max funding over paying back the loan. Now, say for example, you've had the policy for 4 or 5 years and you've got loan interest that's stacking up. So I did have a client in your position, but later in the policy. He was putting in roughly like 250K a year for his policy, and he was in his 4th or 5th year. So he had, I think, almost in the neighborhood of like 400 plus thousand, I think, in loans. And the problem he was facing was he wasn't max funding the policy. So he's got a huge loan, 6%, roughly 5 to 6% loan interest, compounding, simple interest year over year. So he's got a lot of interest built up, and he's got the principal loan. And on top of that, he's not max funding the policy. So and he had a big lump sum of cash and he wasn't sure how to allocate. I said, in my opinion, I would rather you max fund the policy, get it to what it's supposed to be illustrating, regardless of loans. You're supposed to be putting in X amount of dollars according to your plan that you put in 5 years ago. And now you're not following it, right? So it's only 5 years and you're not following the plan. So let's get back on to following the plan, max fund. And then the second, if there's additional money after you've max funded in that same year, I would actually start tackling the loan interest. The principal loan, I'm not too concerned with, because regardless of however long, right, that money is outstanding for, the cash value is still there. It's still growing, and I'm still receiving a crediting rate on those dollars. The only thing that can harm those dollars is the loan interest that I'm being charged. If the loan interest starts to overtake the returns that I'm getting on the cash value, that's when it becomes a problem. that's when, the cash value starts to not perform so well, or the loan interest starts to have a hinder on the cash. So people often ask, if I borrow against my policy, does it affect the policy performance? It's a yes and no. It depends on how much you borrow. If you take out 90% of your cash and only 10% is there, and on top of that, you don't max fund the policy, and on top of that, you don't pay the loan interest, and you let it keep compounding for too many years, yeah, we can fall into an issue. Long term, we can fall into an issue. So to avoid that, I prefer to max fund first, pay my loan interest second. There's additional cash from your returns, your cash flow and whatnot. And then eventually, we want to restore the whole thing to zero so we can repeat the process, right? So right now, in my policy, I've got $69,000 and some change in loans, nothing owed in interest. I paid the interest, I wiped it out. Next year, when I dump in my 70 again, it's gonna register interest again. It's gonna charge me, the way Guardian does it is they charge us the loan interest up front for the whole year.
Right.
And then if we pay it in full, in advance, they actually give us a little bit of an arbitrage, like a dividend on top of that. It's actually quite beneficial when you do borrow money out, leverage, and then pay it, right? So there is a benefit there. But in my case, I'm gonna keep my loan principal outstanding for about 6 or 7 years, and that'll roughly add up to what's 40 times 7, 28, right? 280K, something like that. So I'll have roughly 280 to 300K in loans, and then I'm gonna pay it all back, and then do a bigger deal in something outside of insurance, outside of my own business activity, most likely be real estate. So that's the plan. That's what I set up for me. So for you, just being able to analyze what was your plan originally going into it. I prefer to max fund. Guardian's very flexible. We can add in cash at leisure. I also like to, just take advantage if there is extra cash after you've max funded. Okay, knock out the loan interest. You'll be rewarded for doing that within the policy itself.
So I have another question reference that the second anniversary is coming soon. Do you think that is a good idea? I also have some funds, some investments in crypto and stock market. I can either do a staking on crypto, without selling my crypto and just borrowing out from my crypto. Same concept basically, but with crypto, and putting this money back to the policy. And I can also, let's say, close all my positions in the stock market and just fund the policy right away when the second anniversary comes. Do you think, I know it's going to be a taxable event for the stock market, for the stocks that I have, but for the crypto not. Do you think it's a good idea to max fund right away when the second anniversary comes on my policy by bringing this money that I have aside on this type of investment?
You mean the third year, no? Because you said you already went through the first year. You're in the second now, right? Oh, you're finishing the first year. Got it. Okay.
The first year. Mm-hmm.
All right, we're finishing the first year. We're approaching the second.
Mm-hmm.
And you have it set up where on the anniversary date you pay the premium in full. Is that correct, or is it monthly, spread out?
That's something that I can do, but of course I have to bring this money from stock market and from cryptocurrency to be able to do that. So the question, do you
to just cover the premium? You mean?
To cover the entire policy.
Okay. Well, I'm not too concerned because we have 12 months, right, to max fund. So. Right. I don't feel comfortable selling or closing positions in your outside investments. That's supposed to, in my opinion, more long-term approach. So I don't know if I'm willing to close out or sell any of my crypto, me personally. I like the whole leveraging on the crypto side. That's pretty interesting. I've been looking at that. There's, you can do crypto loans at like 1%, which is nothing when you look at the volatility of how much it goes up, how much it goes down. But I think you can only leverage roughly 50% of what you have in crypto or something like that. Whatever it is, if you do that, you're pay attention to the costs. Doesn't make sense. Me personally, I think I would rather just look at my income and cash flow.
Crypto, I don't want to sell my crypto. I honestly want to crypto because it's getting very active, and I believe that it's gonna go up anyway in the couple months coming in. So, but the stock market, I may be able to because the stock market I'm trading, every day. So I can just close some positions and have that money available to fund the policy, then bring as a loan again and put it back into the stock market. I don't know what do you think about that?
James, you want to jump in? Because I know you're in the stock market area, and this is not my specialty. I'm gonna have to yield.
Yeah. So to start from the beginning, I'm a big fan of max funding it as well. So coming from that position, I agree with Denzel. I probably wouldn't create a taxable event from selling the stock. If you're buying and selling it anyways, like you're not holding those positions and getting to a long-term capital gains position, then it probably doesn't matter if you pull it out, fund it, and then put it back in. If you are trying to establish some long-term positions in order to get the long-term capital gains, I would not sell the stock to do it. I do like staking the crypto, using that to fund it, and then pulling it back out. One of the things that we haven't really discussed in these before is the ability to use or to get a collateralized line of credit against your life insurance policy outside of the insurance company. And you're just about funding to a point where you can do that and get a really good rate for doing that. One of the things that I'm doing right now is I'm in the process of collateralizing my life insurance policies through a bank and getting a line of credit that I can use to practice dynamic and velocity banking with. So something I needed to do because I refinanced my home last year. My home equity line of credit went away. I did a cash out, and so I don't have a line of credit to practice velocity banking with. So this is kind of a priority for me. But what I found out there is available with, you have to have a certain amount of money, but some banks it's over $65,000, some of them it's over $100,000 in cash value available. You can collateralize it with them. You get a really good rate. What I'm looking at getting right now is a 3.25% interest rate. Basically, prime rate -1 is what they're offering me against the cash value of my policies. And that's because I'm doing over $250,000. If it's over, it might be a different rate if it's less than that, but over $100,000 with this same bank. But that's a 5-year line of credit, and they'll increase it as you keep making your premium payments each year, and your cash value potential increases. And they'll collateralize 100% of the cash value. So it's a really good opportunity to be able to make sure that you're max funding it. And even with Guardian, it provides an opportunity for arbitrage, which we're always trying to get that arbitrage happening in order to maximize that cash flow. So
correct. Okay, great idea.
Ideas for you. You're welcome.
Thank you.
Hey Joe, I know you just messaged me on the back channel. You got to head out, so I want to give you the floor to say a couple words, either to Robinson, or if you want to comment on his situation, or if you want to, bring up anything else. Just want to give you that time before you have to go.
Hey Denzel, I appreciate it. Yeah, it's getting kind of late here for me with the family, so I need to go and take care of some of those obligations. But I don't know that I have anything additionally to add specifically to Robinson, other than there's obviously some other strategies associated with the real estate as well that I focus heavily on personally, along with the infinite banking concept and along with the velocity concept, in recognizing how to how to leverage real estate in a way using subject to investments, wrap investments, and creating a structure that allows you to get momentum with little to no money staying into the transaction mix and really create the bank while leveraging that tool as a bank of the life insurance policy or the all-in-one mortgage or whatever it is, the tool that you're using to create that velocity aspect of things in the mix. And so, I really have enjoyed the conversation. Thanks for allowing me to be part of it, Denzel. I look forward to future conversations with you guys. James, it was good connecting with you, my friend. And, I hope everybody has a great evening. Thanks. This is Joe. Blue background at the top of the screen. And I release the mic.
Thank you, Joe. Really appreciate your time. Thanks for tuning in. I typically run these rooms pretty long, so I know people can get a little burnt out. We've got 110 people still watching on live on YouTube, and roughly still got 20, 30 people or so in Clubhouse, so that's pretty cool. Robinson, was that helpful, sir? Did we capture, give you a good
Absolutely.
direction to go in?
Yes.
Cool.
I clarify a lot of things, so yeah, there's a couple great ideas that I'm gonna start checking around and see what I can do with the collateral of policy, and also with the stocks. As James mentioned, I'm trading basically every day, so it doesn't really matter if I close the position because anyway I'm gonna be a taxable event. So in order for me to fund the policy right away, that would be an option, not the best option, but it could be an option just to maximize the policy.
Right, could be an option.
Yeah.
Okay.
Yeah, could be an option. Yeah. Great idea. Thank you very much. I really appreciate it.
Yeah.
Thanks.
Thanks for always, tuning in on YouTube, even here on Clubhouse. Really appreciate your time. I'll move you back to the audience, and I'm going to take some time to lightning speed. I'm going to try and go through a bunch of questions that you guys are asking on YouTube. So I'm going to take a couple minutes to just go through that, and then I do see somebody raising their hand. Tiffany, if you have to go in the next few minutes, just send me a message on the back channel letting me know if you can hang out for a little bit longer or not. But I am going to take a few minutes just to answer some questions on YouTube that are coming in from my audience here. So I'm going to scroll back up to the top, and let me make sure I move my phone here so people on Clubhouse can still hear me nice and clearly. So, question came in earlier from Antonio Rodriguez. Says, good evening, I'm trying to understand what do I do with my money while waiting to fund the policy. I feel that my money is idling, waiting for the next funding period. Good question. So that I'm assuming that you don't have a policy in place, or that you do. Yeah, it sounds like you do have a policy in place, because you said, I feel that my money is idling while waiting for the next funding period. So that means that this guy's already max funded his policy, and he's wondering, I got additional cash. What do I do with this additional cash? So honestly, I'm in the same position as well. I mean, I wasn't expecting to, make a ton of money in the COVID, pandemic or whatever, but I did. And I have 2 policies in place. The total amount of money I'm putting in is $85K a year. And, not all of my money is flowing through the infinite banking system. So I'm not that radical of an insurance agent. And I know that Nelson Nash was. I know that quite a few of the insurance agents that follow the Nelson Nash Institute, IBC practitioners, some that I've come across, tend to be a little more very, very leaning towards running any and all dollars through the policy. I don't typically like to do that, because we have to remember that this is not a cheap product. There's quite a few costs involved in this. So me personally, if I've already max funded my policies for the year and I've got cash sitting waiting to fund the next period, I would say this: let's just make sure you've got the money to max fund for year 2, year 3, year 4, right? Let's say you have that and you've got additional funds that isn't going anywhere. I would say, are you tithing? Have you given at least 10% of your income, right? Not even speaking spiritually, just morally speaking, have you given back to society? Have you contributed? Have you increased someone's life for the better, right? Have you solved that? 10%. Start there. Go up as you feel necessary, okay? Have we done that yet? Okay, let's say you did do that. You still have more cash. All right, what are some other investment accounts that you own that you haven't max funded yet? Let's say you have an HSA, a Roth, maybe you have some kind of self-directed retirement account, or you got a 401k, all these other accounts, right? Have you max funded those? Okay, let's say you did. Okay, so you've secured yourself, you've got emergency funds, you've got savings, you've tithed, you've given, you've invested in your secure accounts. What about some speculative, right? Some speculative investing, or just reinvesting back into yourself if you're a business owner. That's what I would do. If you're on the E and the S quadrant, still an employee, self-employed, making that transition to the B and I, maybe there's some speculative investing that we can do, in whether it's stocks, forex, options, crypto, like things that are more volatile. Consider that. That's my take. So as you saw on the board, like, I do spread my money out. I start to diversify once I've established my main money-making machines, right? I've invested in myself, and now I have plenty that if all hell broke loose in my situation, I could still protect myself, cover myself for the next 2 to 3 years. It would take me maybe in the 4th year to actually start borrowing money if things got really bad. So evaluate that for yourself. What are the vulnerabilities in your kingdom, in your household, that need to be repaired, that need to be fixed? Maybe you've got all the money stuff down, but you're not giving, right? So have you become greedy, in your kingdom, in your household? Have you become cheap with money? Are you not tipping the waiter what they're worthy of that customer service? The hotel, the cleaning ladies, like, think about that, because I've come across some clients that make really good money, but nowhere on their budget does it show anything of giving. Nothing. Whether you're Christian, non-believer, I don't care. Like, morally speaking, just logically, it makes sense to give. You're going to get a whole lot in return, especially when you give from the heart. So sometimes that could be a big block for people that start off with nothing. They built, entire business on their own, and they struggled, and now they're making millions of dollars, or maybe multiple 6 figures, but they became cheap, and they became, constricted and conflicted, and they're not giving. So that can be a dangerous position to be in. You can have all the security you want, but what does it mean to conquer the whole world but lose your soul in the process? What does that mean, right? So really thinking on that is what I would say to Antonio in the comments. Evaluate what are the vulnerabilities in your household. Okay, hopefully that helps. Let's see. Yodita says, I'm a life agent working for a stock company. Eventually, I would like to get into infinite banking. Cool. It could be another, system you add. You may end up not liking stock companies once you learn more about the infinite banking concept and using mutual life insurance companies. You may end up not liking them, those stock companies, long term, especially if you're trying to serve the needs of the client. It does benefit the client to be with a mutual rather than a stock company. That's based off, how dividends are paid out on insurance policies. Let's see. Let me bring that person, Tiffany. Let's get you up stage. Tiffany, I'm bringing you up now. if you're still with us.
Hello.
Hello. Go ahead and introduce yourself and what your question is.
Okay, my name is Tiffany. So I've been watching your YouTube videos for quite a while, and I've always admired the videos, and I'm like, oh my God, it just seems so simple. However, I feel like my particular situation is complex and maybe stopping me from moving forward. So I became disabled after defeating cancer at age 26. So I was relatively young. I didn't have enough work experience, so I didn't qualify for like state disability, but I had taken out long-term disability policy, so I was covered with, private disability insurance. Well, with my particular situation, I have about $22,000 in savings and maybe about $4,000 in cash on hand. I do have multiple stock portfolios. I switched from active trading to just long-term investing. So I have about $10,000 worth of tied up in, just the stock market within itself, where I receive dividend returns and so forth. I've been unable to qualify for insurance due to medical history. And so I was wondering, how can I make infinite banking work for myself?
Awesome. Great question. Very, very tough situation to be in. Once we've been denied by one life insurance company for insurability purposes, typically if I go to reapply again or to another insurance company, they kind of follow suit. So we may want to pump the brakes if we're trying to find a company to force infinite banking to work in our favor. I'd rather not do that. I've had a couple of clients that I've worked with that were uninsurable, or we applied, got denied, and the second option was to look at the spouse, the partner that they were with, right? So if it was a husband, let's look at wife. Or if I'm talking to wife, okay, let's look at husband. And then the next thing would be the children, right? So if I'm in a situation where both husband and wife are both uninsurable, Dave Ramsey, I recently became a certified Dave Ramsey financial master coach, a big whole thing, and went through his whole program. And inside the course, they talk about becoming self-insured, because with the whole Dave Ramsey camp, they don't believe in whole life or IUL or anything for that matter. Or in regards to life insurance, they only believe in buy term, invest the difference type of model, which I'm cool with, especially in the event that I'm uninsurable. So if I'm uninsurable and my family members or my closest trusted family are also uninsurable, and I've got nobody that I can trust to turn to store piles of cash on someone else's good health rating, then I would potentially look into becoming self-insured. And this has to do with their whole model of investing in the market. They don't really talk about building a business, but I kind of would take the Grant Cardone approach, which is to 10x my thinking. There's a client that I have currently. He's disabled from the chest down, military veteran, out in, I'm not going to disclose his location. That's too much, giving too much information. But he's a very awesome guy. He's married, has kids, but he's disabled from the chest down. The only thing he could work is his neck, right? Moving his neck. And I think he has mobility with his arms, I'm pretty sure. And so he is not insurable. But he did put a policy on his wife, or in the process of doing that, if I'm not mistaken. And he has a desire, a goal, a purpose to start a business where he charters a boat, where he takes other disabled veterans that cannot walk, and he puts them on this whole experience to go deep sea fishing, right? So he has a boat, he remodeled, or in the process of remodeling his home, where he provides an entire, mobile access from the house to the lake, because he has a lake right out back that, connects to the, big ocean. And he is, remodeling the boat where you can literally lock the disabled chair, the person that is in their, mobility chair, whatever it's called, and they got to go out on this experience. Now, it's going to cost him a lot of money to do. He's investing a lot of money. He's negative the first probably year of doing this, because he has to obtain the clients, he has to market it, he has to do all this stuff while disabled. He's got the wife to support him, but he's following his purpose in life of what he is, been, whether you want to call it an anointing, a gift, a talent, a skill, whatever you want to call it, he's following it, all right? And so that would be the approach that I would take, and this is the approach I often take when I work with people who have become disabled, injured, paralyzed from the waist down, chest down, whatever it is. We go back to the 4 major questions in life. Who am I? Why am I here? What's my purpose in life? Where am I going? Right? Where am I headed? Where do I want to be? And how does that align with my relationship with money, right? To bring value to the marketplace and get paid at an exponential rate to become self-insured, so that I really don't, say need life insurance. And then, I guess a third option would be maybe a friend, or I don't know, business, where there's insurable interest. That's a little risky for me. I don't know. But based on what I've said so far, Tiffany, does this provide any a guidance, or do I need to clarify anything?
So if I understand you correctly, you're saying in my situation, being that I don't have kids, due to my cancer, I can't have kids, and I don't have a spouse, it would be in my best interest to, pursue self-insurance on myself. And so I'm guessing the only way to kind of go about that is to create more lucrative income.
Correct.
By starting a business.
Correct.
And are you saying investing that income by diversifying it in different interests, such as like the stock market, real estate, and so forth?
Yeah, not necessarily diversify in the beginning. Mark Cuban doesn't believe in diversification, not at the beginning. I don't think Warren Buffett would agree. In the beginning, I don't believe in diversification. I think it's all about focusing on that one sole purpose, that one thing that you're gifted in, that, whether you believe or not, that God will provide, space and resources for you based on your gifts, skills, and talents. When you bring that to the marketplace, and like I said, get paid at a very high rate for that, is my strategy. And also considering a higher credibility above me, right? Go above me, like Dave Ramsey, that whole camp, very popular. They say it themselves, how to become self-insured, where you don't need those other, what they would call high costs of life insurance, whole life or IUL in that sense, especially if I'm uninsurable. Now, I don't want to completely close the door, because maybe there's some other resources out there. Maybe there's nonprofits out there that are helping disabled people. Maybe there's some kind of fund out there. So I like to be very optimistic, do my research to find money in the marketplace, because there's an overwhelming, abundant amount of money sitting in other people's accounts that I would argue should be sitting in your account, depending on how you deliver your gift in this world. I would argue that to the grave. I believe there is an abundant amount of money in other people's bank accounts that should be in your bank account. Not because you need to steal from them, rob from them, take from them, but literally they've been called to help you, serve you, and they need to give. This goes back to my point I was making earlier about giving, right, to others, and it's going to come back at 10x, right? So that would be the approach. I would not just completely shut the door, because who knows? You might get a miracle and boom, you're healthier than you were 10 years ago, right? So there's that possibility. I don't close out anything when I'm dealing with my clients. I'm like, look, you're disabled. I serve this almighty, all-knowing, all-powerful creator. And, a lot of people out there have claimed and witnessed things that I have not personally seen, but I'm not just going to shut the door on it. If there's people that rise from the dead and there's people that get healed and start walking and all this stuff, I'm not going to close that out. I'm going to be very optimistic that my health can do a full 180, right? So I keep that window open. But then I also, stay in reality. And I say, you know what? Here's the situation. Here's what I have to work with. Here are the resources that I have today. How can I maximize this? Who are the top 5 people in my ecosystem that are making more money than me, that are doing bigger things than I am right now, and how can I get in their circle? How can I, sit at their table, eat at their table, negotiate, collaborate at their table? That's my mindset going into this. Does that bring more clarity to the situation, Tiffany?
Absolutely. And I thank you so much. You're always very positive and encouraging. And I'll be looking forward to continue watching you on YouTube.
Awesome. And hey, if keep engaging. I'm constantly doing live streams. I'm always trying to create opportunities to talk to people like this and create conversation. So stay in the ecosystem, and maybe there's someone in the crowd here, or maybe even on YouTube. Who knows? What I like about Clubhouse is you get to see people's faces, and you get to click on their profile and connect with them one-to-one. And who knows, whether it's me or someone in the crowd that says, hey, Tiff, I'd like to serve you, give to you. I've been called by the Holy Spirit to bless you, or whether it's time, money, effort, whatever it is. You never know. So this is why I encourage people, for the now 102 people that are watching, and for the next live streams that I do, get on Clubhouse. Let's have a conversation. Let's see where it goes. So
I received that. Thank you.
yeah, awesome. So I'm going to come back to the YouTube questions. Like I said, if anybody else has a question, I'm moving back to the audience. Go ahead and raise your hand at any point in time. I'm gonna ride this out. I think James, you gotta go. Is that correct? So I want to give you the floor. Out. Cool, man. I know you hung out for 2 hours. I really appreciate it.
No problem. I appreciate you guys. We'll be back again later on. Hopefully help some more folks out. And in the meantime, you can catch me at Oregon Cash Flow Pro on YouTube. And I look forward to helping anybody that needs it.
Thank you, sir.
Keep up the good work, Denzel.
I will. I'm keeping it up. Awesome. All right, yeah, like I said, anybody else in Clubhouse, like I said, you guys get priority if you raise your hand, anything like that. But I'm going to turn my attention to my comments here. Try to go through this a little bit and see who is here. Let's see. Felicia says, my policy is 6 months old and started using it to pay down my debt. Excited to see what the future brings. That's awesome. Great job. Brenda Lee Harris says, love the breakdown and reminder that the discipline has to be there for cash flow, infinite banking to work. I love the recapture aspect, paying interest to yourself, not the third-party financial system. Yeah, here's a thought. I'll go emotional for a second. I believe that the banking process is somewhat of a culture that many minorities in the United States could potentially adopt. I took some notes here. I want to give you some statistics, right? If you guys that are listening, watching, you may have heard me dive into this a little bit. And this is tackling the mindset part, the discipline part, and the cultural, beliefs that we have about money and the system and how you and I operate in the economy. So I love studying other cultures. One in particular, we've got the entire Asian community, and you've got the Jewish community. You've got Mormons. These are three distinct cultures that understand how to rotate dollars very effectively. Now, I went on Google and tried to find some information, but I was able to find that in the Asian community, they rotate dollars. $1 on average gets rotated over a 28-day lifespan before it leaves their community into another community. The Jewish culture do it in roughly 19 days. Caucasian, white, do it in about 17 days. Now, I don't know if this stat is true. This is staggering. I couldn't find anything on Hispanics. I couldn't find anything. But if this is true in the African American community, specifically in the US, I don't know other countries, but according to some research I found, 6 hours in the African American community. I don't know if this pertains to Jamaicans, Haitians, Bahamians, or if this was one lump sum of just minorities in the US. And I will continue to do research, but I mean, if that's true, then Hispanics aren't so far away from that, from what I understand. So that's pretty interesting. This is where it gets emotional, right? Because then you start to say, wow, how is it that these other cultures are doing this? Where, when you look at every plaza in South Florida I've ever gone to has a Chinese restaurant. They're there. The laundromat, the massage parlor, the nail spot. It's Asian. When I went to Bahamas, all their resorts, the Asians, Chinese, they own them. I'm like, this is incredible. Whatever it is that they're doing, I'm sure, keep it general. I want to be optimistic and say that it's majority legit, some fraudulent, oppressive, and we can get into all that. But just looking at the culture behind certain values, certain people that do things a certain way. I know in my own household, I'm Puerto Rican, I'm Colombian. Not once has the conversation of money ever been brought up from 0 all the way to 18, 19, 20 years old. It was me that brought up money conversations in my household. It was me that told my mom, get out of debt. It was me that said, hey, Ma, build your credit. It was me that said, hey, Ma, start a business. Let's go, right? So this is where the passion, the mindset, the discipline may help some of you that are watching, listening, that have been following me for a while say, you know what? That's it. I have to make a change. Whether it's this becoming your own banker thing or just as simply as getting out of debt, getting your money right, building credit, both personal and business, starting your own business, and influencing your community, your culture, to adopt a new culture that will better the culture long term. Now, for me, that culture was the kingdom, for me. And in that, I'm looking at other cultures that practice kingdom cultures, kingdom values, kingdom principles. Principles are things that I can rest on, that no matter what happens, the principle can never be violated. It is the user that gets violated by the principle, right? So if this is principle, if this is fact, that gravity is real, right? That no matter what, that if I jump off a building, I ain't gonna fly, right? I'm dead. That's a fact. There's nothing that I can do to affect gravity. It's a principle. So therefore, I'm able to rest on that and say, you know what? I'm not gonna jump off a building. Doesn't make sense, right? I lose my life. There's too much risk. I have a 0.001% chance of living. So how can we do that with our money? How can we ensure the probability of success with our money? How can we do that? And I think from a fundamental standpoint, how we rotate dollars in our community. Let me go a step deeper. Let me go even deeper. Let's look at the church, okay? And let's look at businesses. I found another stat. It says 90% of US businesses are family owned. And of that 90%, I want to say only 30%, according to some of the research that I've done, only 30% succeed in the second generation. So that literally means I'm Denzel Rodriguez, I'm 25, I start a business, right? And I run it for 30, 40 years, and then I have a son or daughter, which then gets passed on to them. And by the time they're a grown adult or whatever, or by the time they die, the business also dies, gets liquidated, it gets sold, that's it, second generation. That's what that means. So 90% of US businesses are family owned. Only 30% succeed in the second generation. Only 15% make it to the third generation. Who is in the 15%? I already know it's the Asians, it's the Jewish community, it's the Caucasians, it's the Italians. Man, they do it well. So I say, okay, well, how can I, as a Puerto Rican, Colombian, adopt some of that, you know, what the Asians are doing, what the Jewish people are doing, what Caucasian, what the Italians are doing, the Irish, my goodness. How can I adopt that? And I look at them and I say, oh, well, it looks like for the most part, there is a sector of their religion and faith that ties very heavily with how they operate their money. For example, there's cultures that don't celebrate Christmas, right? There's cultures that don't celebrate birthdays. So you could look up, you could Google how much the average American spends at Christmas on the birthday. Let's say it's a couple thousand. I know in my household, I have a mom and a stepdad. Both of their incomes combined do not break 100K. For as long as I lived on planet Earth, never broke over 100K. Yet, they were able to spend 2 to 5% of their income on Christmas. 100,000, 2 to 5%, that's $2,000 to $5,000 of their income that could have been saved and invested over the last 20 years, 25 years that I've been on planet Earth. That's a humongous nest. That's a humongous savings cushion by releasing one culture of celebrating Christmas and adopting a new culture that doesn't. Oh my God. That's one way to rotate dollars back into your community. Is to just recapture 2 to 5% of your income from Christmas and your birthday. Is it going to suck a little bit? Maybe. I don't know. It might actually be really rewarding because you look at what these other communities are doing, right? Let me go deeper. The holidays, 4th of July. How many of you spend thousands on fireworks for 8 minutes of adrenaline rush? 8 minutes. I want 8,000. I want 8 million minutes of an adrenaline rush in my life. Not no 8 minutes. Not no 5 to 10 minutes of opening presents, knowing that I'm broken in debt in the process. Am I getting deep? Let me know in the comments. Am I striking some chords where some of you, that was what you needed? It wasn't the technical details. Now, I know a lot of my audience are technical, right? You need to know the numbers and okay, it makes sense. Great. Once I know the numbers, it makes sense. But there are quite a few of you that need the mindset, the discipline transformation to occur. And maybe when I attack it from a cultural point of view, hey, this is how you were raised. And potentially if you adopt this new kingdom culture in your life, we could easily recapture costs in a matter of 5 to 7 years. Easily. I won't say easily, simply put, right? So maybe that's one way of rotating dollars. Let me stop celebrating Christmas and let me stop celebrating birthdays. Now, what does that really mean? All it means is, hey, I'm not going to spend 2 to 5% of my income on a freaking birthday, on a Christmas. You know, I hate to break it to you, Santa's not real, right? So understanding that, like, wow, like I look back 25 years, we never missed a Christmas. Some people might be proud of that. But in my household, I look and I say, well, what the hell is that? 25 years, you've been celebrating Christmas, but for 25 years, none of you have invested more than 10 grand in anything. No business, right? So my household, Puerto Rican, Colombian, and my stepdad is Irish. I think a little Italian, Polish, something like that. And the disconnect of money. And I'm just like, wow, when will the shift occur? So maybe that is something you ought to consider. Oh, wow, you know, I get it, become your own banker, and that's a product that we can eventually get. But you're going to need capital to fund anything. Most of you just need the capital, and then you'll get started. But since you don't have the capital, you get stuck and you stop and you quit. And I'm simply bringing to you a strategy of saying, hey, let's change the culture. Has nothing to do with circumstance or the color of your skin. I don't believe in that. I don't believe that, me personally, the color of my skin is going to dictate how my life will end up. I don't believe it. I refuse to believe in that. So I say, you know what? I am going to take on individual responsibility as a kingdom citizen and also as a citizen of the United States. And I'm going to adopt a new culture. And that may include not celebrating Christmas, not celebrating 4th of July, not buying gifts is what I mean during Christmas. Like actually celebrating what it actually means, right? The birth of Jesus, like, come on, you know? So, and then birthdays, you know, not getting a present, but just spending quality time with the person that I care about. Having a conversation, you know, once a year. Here's a new culture. Once a year, when the person increases their age by 1, right? Your birthday, you do an annual business kingdom economy meeting in your household, husband, wife, and the kids. Whoever turned a new age, you have a kingdom economic get together, sit down, whatever you want to call it, and you discuss. Here's how we're going to impact. Here's how we're going to make a drastic shift in our economy. And here's how we're going to impact the local community and influence that our people, our culture, to strive to do better. And then we influence other cultures and we gain the power, the authority, the businesses, and now we're on every street and every corner like a McDonald's, right? What's the harm in that? And I think one of the most effective ways to possibly do this is through the church. Through the church. The church is one of the best places to gather a local community. So imagine in the church, a kingdom-oriented church that welcomes all cultures to adopt the kingdom culture. And then in those Sunday worship events, those meetings, those Wednesday night prayers, whatever it is, every quarter, every month, or whatever it is, they have a kingdom sit down where we discuss all the economies at that church, and we talk about how do we rotate dollars in this church. Oh, well, Sue runs a car washing business with John. They've been married for 25 years. And David over here has a tax business. So Sue and John can do business with David inside the community. And then David will bring his car and his wife's car and his son's car and tell 4 or 5 other friends to go to this car wash instead of the general one, right, at the gas station. No, we're going to go to the mom and pop. And then Samantha has a Spanish restaurant. So, the service is food. Okay, well, Whenever the family wants to go out and eat, we'll go there. And then Tim has a financial coaching business, and then Mary has a life insurance business, and Deborah has a life coaching business. So they're all in the kingdom. They're all in all different nationalities and cultures, right? This is really cool. It's not exclusive. So all cultures coming together, rotating dollars in the same community, building up businesses, increasing capital, and then establishing your own banking system in each household where the death benefits of each kingdom citizen, roughly 10% or more, goes right back to the church, and then the church can fund capital ventures, can fund ventures into the second, third, fourth, fifth, sixth, seventh generation from one church, because each kingdom citizen understood, oh, this is what I need to do to ensure that my children's children are set up financially, but also morally, constitutionally, the culture of the kingdom is now in the household, right? We've adopted these cultures that put us way ahead. Has nothing to do with how much money you make. It's all about what you keep. It's all about what you keep. I have clients that make over 6 figures living paycheck to paycheck, yet I have a single mom that is Asian that makes 50K, but she lives off 25,000 a year and is able to save 30 to 40% of her income to become her own banker, and then the husband operates the same. It's amazing. This stuff is amazing. Am I getting somewhere? Is this landing? Are you guys liking this? I know Anna has a thumbs up. Yolanda says, thank you for the wake-up call, willing to tell it like it is. I hear you and walk in the light you shared by God's grace. That's from Yolanda. William Johnson says, agree. Too many holidays, and if I don't bring home the dozen roses on anniversary, Valentine's Day, birthday, Mother's Day, I'm in the doghouse, right? That's a culture, man. That's a culture. Like, man, isn't that terrible? That whether it's the husband or the wife, putting on these expectations to supply the needs in your household for Valentine's Day, Mother's Day, Father's Day, Christmas, birthday, a New Year's, all these holidays. It's every single holiday is roughly 1% of your income. So imagine, or 1 to 2%. So imagine you just redirected, say, 2 out of the holidays. All right, maybe Christmas is too hard. All right, well, let's get rid of Valentine's Day. What the heck is that about? Right? Let's adopt a new culture and say, okay, we're not going to celebrate it. That's our culture. I'm not going to celebrate Valentine's Day and 4th of July, and I just rerouted 3% of my income to save, invest, and give. You start there. You build up the capital. And then you influence the wife, the husband. You say, listen, I want to be free, independent, kingdom citizen of the United States of America. I want to be free. That's the whole point of this country, to be free, right? Exercise your opinions, state your thoughts, your statements, right? Speak your mind, share your stories, your truths, right? Your failures, your successes, and make something of yourself. Individual responsibility. Can we do that? Is that possible? I think so, but I'm gonna have to not sacrifice. It's not a matter of sacrificing. It's just a shift in the culture. That's all I'm doing. I'm just shifting the culture of your household. Okay, instead of 14 roses, I'm going to give you 14 reasons why I love you. And I'm going to write it down, and I'm going to shout it out to the top of the roofs to my neighbors. Maybe that's more valuable, Instead of a dozen roses, I'm going to give you a dozen strategies to start a business, the two of us, husband and wife, to start a business and multiply wealth. How about that? How do you like them apples for Valentine's Day? On your birthday, I'm going to give you, if your wife's turning 45, listen, on your birthday, I'm going to give you 45 reasons why I'm going to be the very best man you've ever seen in your life, right? And vice versa. The wife, husband's turning 40, 46, 47, whatever it is. Hey, husband, as a wife, I'm going to give you 47 reasons why I'm the woman of your dreams and why this marriage is going to last another 40 years, because we're going to change our diet to live longer, to give us more time to create wealth. We're going to beat the average life expectancy in America of roughly 70 to 80, and we're going to beat it by 20 years. We're going to live to 100, which gives us an additional 20 years to establish and ensure wealth that we create a legacy worth living for. Am I getting somewhere? Am I getting somewhere? Candy says Kingdom Community. Yodita says love it. Stevie, cool. All these holidays are just retail sales days anyways. All right, cool. Let's see. Try and find some questions. So I'm going to break down. I'm going to stop with the emotional approach. I'm a technical guy, but I can definitely get passionate when I truly believe in something. All right. Let's see. Way Out West says, there was a very prosperous black community in Tulsa. I know of this story, where money changed hands on average of 19 times before leaving the community. Unfortunately, that community was burned / bombed to the ground. Yeah, for those that are very interested in that story, it's called, just look up Black Wall Street. You'll be astonished how they operated in a kingdom-like manner. You'll be astonished how they operated, right? Look that up. Maybe that'll be the shift. You say, wow, wait a minute. My culture actually used to operate like that, and now all I got to do is repent, which means to change my way of thinking and re-establish, remember how my kingdom culture operated. So you may not even have to look too far out. You may just have to just look at history a little bit and see what were the things that occurred, right? Whether it was a bad thing, a positive thing, and everything in between. Just look at the economic system of how they operated. How can I adopt that today? Because if they did it back then, when there were lesser freedoms, what makes you think we can't do it now in an environment where there's more freedom than ever before, right? And that could be argued, I understand, depending on what circumstance you're in, and totally get that part. But if they did it back then, who's to stop you from doing it now in the 21st century? James Holly says, you're on a roll, D. Thank you very much. Yeah, sometimes that Holy Spirit be taking over me. Thank you for your channel, Denzel. From Tan, I'm very thankful for transparency and the kingdom mindset. Same goes to Oregon Cashflow Pro. Yep, we really liked him. Obviously Global, cool. Let's see. Oh, we got Savings Minus Debt in the house. Another YouTube channel. You guys can check him out. Great guy. I've collaborated with him in the past. Let's see. Denzel from Ramon. Denzel, after you get outside a collateralized bank loan, does it prevent you from doing a loan with the insurance policy directly? I want to say yes. For those that, it was discussed earlier about the cash value collateral loan is what it's called. Cash value collateral loan. I know there's some requirements. You have to have a certain amount of cash value, like Oregon Cashflow James Pro said earlier. You probably have to have the policy in place. You probably can only leverage a certain amount. I do think you are relinquishing some freedom of the cash value. You're basically collateralizing your existing cash value to get a bank loan at say a lower rate than the loan interest rate on the policy itself, maybe 4% or lower. And if you're doing it as a business loan, the interest could potentially be a write-off. So it's a very interesting way of looking at that. I have not done it yet. I made a video that I was going to do it. I ended up not doing it. There's just more moving parts that I need to learn to properly do that. Daniel says, what about premium financing? Yes, allows needed coverage without liquidating other assets. So for those that are listening still, premium financing is another strategy that I'm not personally practicing. I don't know enough yet, but the idea is that you are coming up with some of the capital to overfund a whole life policy or an index universal life, and then you're making a partnership with a bank that's going to fund your policy as well. But the money that they give you is debt, obviously, at an interest rate. And the idea is that the money you'd be compounding in the policy would be able to be a substantial amount of cash value to live off retirement. So it would be it's a retirement strategy more than it is a banking strategy. I would say that premium financing is more of a retirement and death benefit strategy than it is a banking strategy, like using it, taking out loans here and there. Like with a premium financing, I don't believe you can take a loan out for the first 5 years or something like that. You don't have full access to the cash. So that's why I'm not personally practicing it. I believe I can earn more money than what my whole life or IUL can do. Which is why I create a strategy outside of the policy to benefit the two. Okay? Hopefully that helps. Let's see. From Via Keys says, is there some way I can roll over my 401k to another IRA penalty free? I don't think so. I don't have the answer. I'm just going to yield that. I don't know the answer to that. If somebody does know the answer, you can put it in the comments of certain strategies that can be done. I know there are, rollover from a 401k to a policy, 401k to a self-directed IRA or Roth IRA of some sort. No matter what, I think there's going to be some kind of fee. I know with a 401k, you have the option of a, what is it called? The 72T rule, where you can take out early distributions penalty free. I do know of that. There's 401k loan penalty free, but there is an interest rate that you're going to get charged and that such. So let's do a couple more questions. When you run your money through your policy, it does not stop your other goals. You run money through policy first, and via policy loans, do all the other things that you plan to do with your money. Okay, that's from William. Got it. Cool. All right, so Denzel, can you have some of your member/agent contact me, please? I'm interested in getting a policy. I'm a longtime follower. Absolutely. So although I'm a licensed insurance agent, I'm still not, I don't know everything yet. I'm working with people. The agency that I'm partnered with is called IBC Global. Steve Parisi is the owner. He's got roughly 30, 40 employees, quite a few agents under his belt that are doing these types of policies day in and day out. So they're going to be more efficient than myself. You can think of me as a very highly educated customer that's practicing the concept and getting results. So I'm more of a strategy guy than I am just putting policies in place. So when people do reach out to me and say, hey, I want to put a policy in place and I want you to be my agent, I'm like, great. I have a very extensive process. Number one, I want to build know, like, and trust, not only for you to me, but me to you. I need to know that you can do this financially, right? Because I'm 25 and I really am focused on building a reputation that will last multiple generations. So the last thing I would want to do is just be selling policies left and right to people for commissions and, making a ton of money, which is all fine and dandy, but I want to reduce my failure rate to 0, right? So far, I know, I can count on my hand the amount of clients that I've worked with that have failed. And we're roughly at 4 to 5 people that out of the 1,000+ people that I've worked with, about 4 or 5 people have failed, meaning they didn't like, die, or they didn't just full out quit, but they stopped engaging with me personally, or they started a policy, canceled it, so they killed it. So that, in that sense, that was a failure. And maybe they went on to do something else. But the communication stopped, and they either stopped the policy, or they stopped doing velocity banking, or maybe they were building their business and then they decided to close their business, or in many cases, or in those few cases that I've worked with, they choose to not listen to the guidance on the one-to-one calls that I, worked with them on. So that is also something that's out of my hands. If I say, hey, go left, and then you go right, and you get smacked, that's not my fault. I said go left, and then you went right. In simple terms, right? If I said, hey, pay this debt first, and then you go and pay another debt because you think, whatever, you watch 4 videos and now you're an expert, that's you. So I know there's certain things that are out of my control, and that's why I'm very, 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 I don't want to say picky, but just I'm very detailed oriented. I don't want people to fail. You're already, for the most part, people that I work with, you're already, 1, 2 generations, 3, 4 generations behind these other cultures. The last thing you need to be doing is failing more. You've already seen enough failure. Like in my household, I've seen enough failure to put 2 and 2 together to say, you know what? Yeah, maybe I didn't work and swing a hammer and dig holes for a living and these hard jobs, and I didn't have to do all that. Doesn't mean I can't relate to it, understand it, learn from it, grow from it, and just avoid all those financial mistakes they made and just adopt a new culture, right? So I don't necessarily have to dig the same hole they digged for themselves to get an epiphany, right? And get results. No, I don't believe in that. I think that I can learn. I say, oh, wow, he dug a hole and then the water came in and he drowned. Wow. Let me not dig that way. Or matter of fact, as I dig, I'm going to lay some cement, I'm going to border up the walls so that so it can't cave in on the hole that I'm digging. Maybe that would be better, right? So it's just a, perspective. How's everybody doing in Clubhouse? I didn't see any hands raised, but you guys are just like hanging out. Really appreciate it. James, Emma, Andre, Gerard, Lola, Sherry, Nolan, Jessica, Chris. How you doing, Cam? This is by far probably the longest live stream I've done so far. We're approaching 3 hours. Still got 85 people watching and a good amount on Clubhouse. This has been a ton of fun. I even had Steve Parisi was in the chat. He was giving love and responding to some questions. I'm going to go ahead and close it out here. I'm about fried. My brain is about fried at this point. So I don't want to start saying crazy things and slurring my words. I'm 25, so let's not do none of that crazy stuff. It has been an honor, a privilege to have conversations with all of you. Some actionable steps, action steps for those that are, say, brand new. Maybe you just found me on Clubhouse, or you catch the replay on YouTube. I have a playlist called Velocity Banking Pregame Work. I usually send people there first. I do have a program. I've got an online course. It's more than just videos. I do private networking events, client only. I do private live streams, private collaborations. I also do one-on-one coaching, me personally. I call it performance-based coaching, where if you watch my videos, you do the work, right? I can see your progress in the course, the platform that I'm on. It's called Kajabi. I can see everybody's progress. I can see the amount of times that you logged in, the last time you logged in. I can see exactly where you left off in a video. I'm like the eyes in the sky. I can see how committed people are. And then what happens is once they get to a certain point, according to my performance-based coaching guidelines and rules, they reach out to me and they're rewarded with one-to-one coaching by me for free, right? No cost. The cost is the monthly subscription or the annual subscription or the lifetime option that they're paying, okay? That's how I operate. If you look at the descriptions in all my YouTube videos, you'll see all the different resources that I personally use, got results from, whether it's business credit, personal credit, life insurance, investing, taxes, business planning, need a business plan, bunch of different legal protection, identity protection, business protection, so many different resources that we all are going to need at some point. We just got to put it in order. And so I do have a resources page where I go through that. Last but not least, for those that are in South Florida or plan on traveling to South Florida anytime soon, there is a business conference called the Vault Conference from September 1st to the 4th, hosted by Patrick Bet-David, YouTube channel called Valuetainment. Great content for entrepreneurs, those that want to become entrepreneurs that aspire to be successful business owners. Great channel to watch. You know, he's a little less hype like Grant Cardone. You know, Grant is so hype and so, you know, exciting to watch, and Patrick is more of a technical, you know, numbers guy. So if you like that approach, great channel to visit. I've learned so much from his content. But he's hosting a huge business conference. I think roughly, I don't know, 3,000 people are probably going to be there. Who knows? It's going to be exciting. It's great to get back out, you know, and in person, live events. And then September 22nd to the 25th, I'll be in Austin, Texas for an event called FinCon 2021. This will be my first time attending FinCon. It's where money and media meet together, so all your financial gurus, coaches, influencers, content creators, digital marketing people all come together to talk money, talk investing, diversification, everything. Everything under the sun in regards to money gets apparently discussed at FinCon. So I'm excited for that. So I will be in Austin, Texas for that next month. And the next live stream event is going to be, I think, next week, the 27th. I'll go live again, so you guys can tune into that. I'll be doing a private networking event this weekend for my clients only. So for those that are in the house that are clients, I'll be there. And that is it. That is the deal. So I'm going to close it here on Clubhouse. Thank you guys for tuning in. God bless you all. And I look forward to talking soon. Have a good night. Okay. So I ended the Clubhouse. We're going to shut that down. My phone's about to die anyway, so perfect timing. And then let's see. Let's see. Cody says, hi Denzel, been a follower for a while now. Watch a lot of your stuff on YouTube. Huge thank you for educating me, helping me start my journey to understanding my finances more in depth. Awesome. That'll be the last comment I take a look at. This has been so exciting, a lot of fun. And so we're going to close it out here. Thank you so much. That was all the information I wanted to share. I might have missed something, but we'll cover it next time. Enjoy the rest of your evening. God bless you, and talk soon. I want to bring to you helpful tools and tips that you can use and implement in your life. So you have to define these words for yourself so you can understand how you can proceed in life in terms of making money. Work means becoming a king. That's what work means to me. But it's up to you to actually put in the work so you can see where you're at, what you're doing. This way you can see what you're up against and how to tackle it. Learn your purpose in life so that you can fulfill it and help others do the same. That's like my personal mission.